Howdy. Welcome back to Dion Talk. This is going to be a nice short live stream that lasts as long as the questions do, which typically is somewhere around 3 hours, as long as the questions keep coming in. I really want to control myself during this live stream because this is a heated topic. This is one where for almost 2 years, since 2013 really, so almost 10 years, there have been people screaming about a housing crash, and I have been saying there isn't one coming. And if there is one coming, it almost doesn't matter because I'm a buy and hold investor. So a lot of my information is for buy and hold investors, but I hope I can help flippers, wholesalers, people who do the BRRRR method, people who have different strategies, even people who invest in stocks or growing a business. My intent is to help people reach financial freedom by getting the concept of money down. But my problem has been the people who are looking for an excuse to take no action love crash videos, love crash articles. They get more views, they get shared more. So when we see a crash video that gets hundreds of thousands of videos, and I've made 2 videos, one in 2020 and one in 2021. I might have got that wrong. No, they were both in 2021 on why there's no crash coming. The first one was no crash in 2021. The second one was no crash, maybe a correction. Because the investor that waits, that stops and says, I'm going to sit on the sidelines and then wait for the crash. And when the crash happens, then I'm going to jump back in and find the great deal. So even if that was the case, let's say as the housing crash that we're in right now is happening because interest rates, that was the biggest, quickest change in interest rates that I've seen that caused what I'm calling the housing crash. If you've been on the sidelines for the last 6 months, just sitting there, not taking any action, not doing any work, and you tried to jump in today, pardon my language, you'd have no freaking clue what a good deal was. It takes for an investor who knows his area or their area, knows their rents, knows all of these factors, weeks to figure out what a good deal is until you're dialed in. If you're a new investor and you don't know how to calculate area average rents accurately today, not what they were 2 weeks ago, you don't know how to find your yield based on what those deals have been with current interest rates, which pretty much change weekly, how do you expect to just jump right back in and take action? So I see a lot of people in the comments recently where they say, we're starting the housing crash, so I'm going to sit back and do nothing for 6 months, and then in 6 months, I'm going to jump in. 6 months from now might be the perfect timing. But that means 3, maybe 4 months from now, you need to start doing the work every day to dial in and figure out what is a great deal. So I want to cover a couple of the reasons why I think we're in a housing crash. And it's not, my crystal ball is way over there. It's not a prediction, in the future, I think this is going to happen. These are things that are happening right now. For the last 2 years, majority since 2020, when the pandemic hit and everybody swore there was a housing crash coming, Ken McElroy predicted a 40% housing crash. He has since gotten off of that, which is great because I watch a lot of his content. If you get a chance, Ken McElroy, it's a great channel. He's on there with his wife, and the great thing is he is, decades of experience and a huge investor who does things that I can't relate to. But his spouse is new to investing, has 3 rentals, and is like the dynamic between them. The information is perfect for a newer investor, or in my case, a smaller investor. My goal, right now I have 16 rental units. I reached financial freedom in 2018, and a lot of investors talk about getting to 50 or 100 rental units, and I'm not even sure I want 16. I might sell some, pay off some debt, and increase my cash flow and have less headaches to deal with, because my goal was financial freedom, not a massive portfolio. And when your cash flow, like mine right now, is about 5 times what I spend in a year, I don't know that I need more. I'm going to buy more, especially in this next year. I am super excited for the deals that are going to start popping up. I made a deal today, this morning. I literally texted Matt, the lumberjack landlord, and Michael Zuber, and I asked, does the excitement ever get less when you find a great deal? Because I found a great deal. I have my offer submitted. Because your heart rate goes up, you get nervous. We go through all the same things. 10 years, a little over 10 years of investing versus that first year, same thing. because it's a great deal and I don't want to miss it. So I have to run my numbers. I have to make my offer competitively. I have to make sure it's a good offer and not chase the numbers, especially during a housing crash, when progressively each deal that we do going forward is probably going to be better and better than the last one. So the difference between this crash and the 2008 crash, and the first thing to talk about is sometimes people will reference, we're going to be hitting a recession. So during a recession, we might see housing prices drop, which is possible. And this is a chart, if you can make it out. The yellow is what happened to home prices during 4 of the last 6 recessions, and the orange is the drop in 2 of the last 6 recessions. So a recession doesn't always guarantee home prices are going to go down. The reason we're going to be able to get better prices going forward isn't the recession. It's fear of missing out changing hands. For the last 2 years, while I was screaming at the top of my lungs pretty much that there's not a crash coming, that you need to keep doing the work and to keep taking action, because imagine if 2020, you watched a YouTube channel or read an article that said there's a crash coming, don't do anything, sit back and wait for the crash. We've had over 20% appreciation in 2020 and 2021 in most markets. I think 19 was kind of the average for most places. In my area, around my area, it was 24%. 2 years of that, with a couple $1 million portfolio, you're talking about losing $500,000 in appreciation, which doesn't really matter because that can go away if home prices drop. But we've also seen massive increase in rents. In these 2 years, rents have come close to going up 50%. So if you were collecting $1,000 2 years ago, that's at least $1,500 now. Most of my places that were rented for $11 or $11.50 are now going for $18 or $2,000. That's a significant increase to get in those last 2 years. That's a lot of cash flow to have missed out if I was waiting for the crash or correction. So for those 2 years, I've been saying hunt for the right deal. The one that gets your yield, the one that puts your money to work so you're not losing value to inflation. My advice for the next 2 years isn't much different. You're going to hunt for great deals, but there are some things we're going to do that are different. For the last 2 years, buyers had fear of missing out. We were in a strong seller's market. We had a ton of demand, limited supply because the other chart, and I need to someday figure out how to share my screen, but I am not a tech guy, so I haven't got that figured out yet. These are homes built by the decade. So each one of these blue charts is each of the last decades. You see the red one? That's the last 10 years. That's how under building we've been. So when people talk about a housing shortage, part of that has been because we're just not building. When the 2008 housing crash happened, builders took it really hard. So where's the motivation to continue that? So we've had really limited building. So we still don't have much supply. It would take tripling our current supply on the MLS, which is going up, to even be in a balanced market. That's how far we were into a seller's market where sellers had all the power. In 2018, you could buy a property and it was pretty much just assumed that the seller would pay closing costs. Since 2020, people had to go, speed is your best friend. You wanted to get an offer in before the seller realized how many offers they were going to get and how much over asking they were going to go. Because a lot of sellers purchased it 20 years ago, can't believe how much prices have increased, and they can't believe that the number the agent is telling them that they're probably going to get. So when they get the actual offer at asking or above in the last 2 years, they jumped on it, and then you get the sunk cost theory where they think they've got time into having accepted your offer. So they might even get offers after that were better that they don't take because they've already accepted yours. So speed mattered. And I mean, you find it on the MLS, you have hours. It's like within minutes to take action. You reach out and get your letter of pre-qualification from your lender, which if you were qualified to borrow $500,000 and the deal you found was worth $400,000, you didn't send off a letter saying you could borrow $500,000 because that lets the seller know you actually have more wiggle room in how much you can borrow. You reach out to your lender and they send you a letter of pre-qualification for $400,000, the amount of your offer. And so my lenders know they've got maybe 10, 15 minutes to respond when I email them for that letter of pre-qualification. I might give them an hour or two if it's on the weekend. And then my agent knows that when I say, this is the offer I want to submit, here's my letter, my pre-qualification from my lender. I need you to make this offer, get it DocuSigned to me in minutes because it goes email, text, phone call, all in about 15 minutes. because if I don't have that email response, it's going to text and then email or phone call, because speed mattered. And most offers for quite a while, and I say most because it's right around 50%, and in most years it was 20 to 30% of offers that would go over asking. Redfin recently had an article where they said 53% of offers were made over asking price, which meant 47% were at or below asking price. So speed, over asking, and then people were waiving contingencies, something that I haven't done and I don't recommend doing. If you were making an all cash offer and you knew your numbers, you can waive an appraisal. So I understood that. But if you had to have money from the bank and you waived the appraisal contingency and you didn't have the money to cover the gap, you could lose your earnest money. Deals aren't that good to risk your earnest money. And then waiving your inspection, to me, that was always a mistake, not because I care about the inspection being done, because you can do that yourself to give yourself that to-do list, but because you need the inspection period. The number of days, somewhere usually between 5 and 10, where you have the actual time to go and look at the property and make up your mind. If you even actually want it, that's when you find out, is the street super noisy? Are the neighbors really messy? Is there some other reason that's not easily discernible from the MLS as to whether you would want that property or not? So that's what people waiving inspections. There was the case where the people offered to name their kid after the seller. They didn't even win the bid, offering to have named their kid after the seller. That's how far we were into a seller's market. So buyers had fear of missing out. I'm a buy and hold investor. I've actually never sold a property, so I can't generally help with that kind of information. I have people I would refer you to if you were selling properties to ask them questions. Here's the shift. The buyers had fear of missing out because prices were going up. So a home buyer buys based on payment. Interest rates were really low. So the fear was interest rates might start to go up, reducing your buying power, or prices might go up so high that you can't afford the payment. So home buyers are there's four people who pay for properties: home buyers, investors, flippers, wholesalers. That's the order of who will pay the most, because home buyers will buy based on payment, investors will buy based on yield. So how much can I make when I buy this property? And then flippers need the margin to be able to exit the deal with profit. And then wholesalers need to be able to get that wedge between seller and buyer so they can get their money. So home buyers were afraid prices going up, interest rates going up might make them not able to make the payment for the house they want. Investors were afraid because I couldn't find the yield. As prices kept going up, it got harder and harder to find the yield. Rates came down, which made us able to pay more, because the same amount of money was going out, more money was going to the seller than was going to the lender. Interest rates went up. And I actually have a video coming out Thursday where I talk about the Fed has raised rates twice. They're talking about raising them 5 more times in this year. And that's rough numbers. I think it might be 4 or 5 at this point. Rates went up, and then for the last 2 weeks in a row, rates came down, even though the Fed has raised rates twice and is talking about raising rates more. So on Thursday, my video will talk about why did rates come down for the last 2 weeks with all that going on. So now the fear of missing out shifted from the buyers to the sellers, because there are some people who need to sell their house. In every market, there are people who change jobs, move locations, decide they don't want to be an owner, have tenants, death in the family, divorce, all of the reasons why they need to sell, whatever the reasons are. There's a million of them, and you're probably never going to know the real reason why the person that sold the property that you bought even actually sold it. Agents will come up with a pretty good story, but you might never know the real reason. So that's a small element of people who have to sell. There's a large element of people who start thinking, these numbers are huge. I've got a ton of equity that I can 1031 into something else, or I can take out and invest in stocks if they want to get out of real estate. Whatever the reason is, there's a large group of people that were thinking prices are getting so stupid, it makes sense. Michael Zuber did this in 2006 to 2008. He saw affordability dropping so low that it made sense to get out of single family, take all that money, and then buy multifamily. So there are reasons why people make a pivot. If you are the seller and the price goes up so stupid that you're thinking, I don't want to sell my property. I love it, but that money is a lot of money. So now I'm going to sell. But you waited. You're waiting for prices to increase to the stupid number that made more sense to you. And then interest rates have doubled in the last month or so. And the deals that closed in the last month, remember, those went in contract a month or two before that. So those were the tail end of those low interest rates, were the record low interest rates for decades. So not only Were people buying properties at low interest rates able to pay more, but people with properties were refinancing to lower interest rates. I purchased properties before 2018 that had interest rates between 5.5 and 6%. In 2020, I refinanced a couple of them to 1 to 3.1, 2 to 3.0. So I did refinances to increase cash flow, which is what I invest for. Now the seller is thinking, prices have finally gone up to the point where I want to sell, and interest rates change. Buyers vanish. Some are priced out. They were qualified to borrow $500,000 2 months ago. Now they're qualified for $380 because the interest rate changed the amount of the payment, offsetting their debt to income ratio. So they can't buy the house at the price that the seller decided they wanted to sell it for. The yield disappeared for most buyers because rents have gone up astronomically, but they're not there yet in most markets. So the yield didn't exist. So investors pull out, home buyers pull out. Flippers see interest rates go up with talks of interest rates going up farther. So even if they use hard money to acquire, their exit strategy now has to factor in higher interest rates. The Burr method has to factor in higher interest rate for that. All kinds of buyers backed off. I think it was Zillow or Redfin that talked about 72 or 73% of buyers in their poll saying, yep, I'm not going to buy now, which reduced demand. The only reason we haven't seen a massive decrease to prices, which we are seeing decreases from the wish prices, those prices where it started to make sense for somebody to just say, it's so bad now, or it's so crazy now, I'm going to sell because I thought I have a single family house that when I decided to pay it off, I owed $121,000. Right now, it would get $450 or so, and I think I would walk away with right around $400 to deploy after agent fees and some other expenses for selling. That's almost 3 or 4 times the amount of money. Even I was thinking, if I sold that, I could pay off 2 mortgages on a duplexes, or I could buy another small multifamily, and I could increase my cash flow as prices got stupid. But if you waited too long and interest rates changed, all those buyers back off. Here's the reason why we haven't seen like a massive correction. And remember, the biggest housing correction that has ever happened to the market as a whole wasn't in 2009, when we had in a year an 8.9% drop. So people who invest in crypto or stocks, and in March of 2020 we had a 30% drop in most of metrics for the stock market. I know my retirement account took that hit. Crypto, Bitcoin has dropped 40%, 9 times in the last decade. Very volatile, and they bounce around. Real estate doesn't do that. An 8.9% drop in the real estate market across the whole market is the biggest one we've seen in 50 years. Now, there were some markets where we dropped significantly, but as a whole, they didn't. So when we talk about a housing crash, the whole market dropping 8.9% would be the largest drop we have seen. So if it drops 9%, that's a new record in 50 years. What I'm talking about is home prices coming down from the wish list. So if they drop down to 2020, 2021, 2019 prices, is it really a crash, or did they go back to where they should have been because of the low interest rates driving prices up so high with limited building? For 2 years, not 2 years, for the last few months, anytime I talked about a crash, and my friends talked about a crash, my other content creator friends, we were trying to clarify that there's a crash in transactions, that so many buyers have pulled back, and people are locked in. The move-up buyer, the person that used to have a house and would say, okay, so our family's bigger, we've got more money now, we're going to sell and get a bigger house, can't, because they own a house that they purchased at a lower price with a 3% interest rate or 2.5% interest rate. Now interest rates have doubled. So if they go to buy a more expensive house at a higher rate, they're going to, even just getting a lateral house, like the same house with a new rate, could add significantly to their payments. It's called the interest rate lock. There are people locked into those, which are 2 transactions from the housing market. They're not going to sell the house they're in. They're not going to buy the one they would move up to. They're going to maybe take out equity and invest it into their property, upgrading it. But we're removing transactions. So we're seeing a crash in transactions. And me and my friends have been trying to say, we're not going to see a crash in prices. We're going to see a crash in transactions. Well, interest rates went up so fast, we're seeing the crash in transactions, which is causing a couple of things to happen. Lenders and agents are going to start starving. right? 70 something percent of people pulling back from buying, the move up buyer canceling 2 transactions. You see lenders start to be creative with uh, new loan options where you can get part of your down payment compensated. Adjustable rate mortgages start to talk about in a new light, where they were one of the largest factors in the 2008 housing crash. We were over 50% with adjustable rate mortgages in 2006 and 7. Right now, we were at 3%. Now we're up to 11%. So there's a big jump going on there, but we're not at 50%. But for a lot of people, an adjustable rate mortgage doesn't make sense. People with a huge portfolio where it's just on one or two properties where they have an exit strategy in the next 3 to 5 years, where the adjustable rate isn't going to sink them, sure, totally get it. It makes sense. But for the average person who hopes for prices to go up in the future and hopes for rates to not be 2 or 3 times what they are now in the future and hopes that they still have their job in 3 to 5 years, is caught living on hopium. And you don't want to do that. What we're going to find now is those sellers who thought prices have gone up so much that they're silly. I need to sell. Here's the one metric that will make people drop prices, and we're seeing it. I saw it in the deal I made this morning, the offer I made on the deal this morning. Days on market. How many days does a property sit on the MLS is the only metric that will make somebody lower their price. You'll see people list prices too high, too low. The agent has an idea of what will drive the biggest frenzy towards the property. Everybody has a different opinion on how that works. But when they put a property on the MLS at the number that made sense to them, for 2 years, speed was our friend. You wanted to get that offer in fast. Now, I'm not even really looking at properties unless they have at least 10 days on market. Remember, it was 2 hours before properties would be under contract. So in my area now, the small multifamilies that I'm looking at, once they hit 10 days on market, I start looking and thinking, what percentage less would I need to make where I would get the yield I want, where I think the seller could still take it, where they might agree to it, and then I make the offer. About a month ago, or maybe a little more, I made the offer of a $1.3 million fourplex I found at 1.1. It didn't sell. That is a seller who saw the wish price go high enough where they listed it where it made sense, but anything less doesn't make sense to them. So it's still listed. They might pull it off the market. They might leave it on there. It doesn't cost to leave it on there, so there's no reason for them to pull it off. They offer today, 11 days on market. They had their price. I'm not going to give much details about it because they haven't accepted my offer yet. So I made my offer lower than their asking price at the number that made sense to me. That's where our price correction is going to come in. We're going to take the wish prices that sellers are thinking they can get, and we're going to make the offer at the price that makes sense to us based on the other 2 factors, rents and rates, because rates, rents, and price help you determine your yield. There's a few more factors there, but those are the main 3 key things that you can watch to understand how it's going, what your number is going to be. So there are some things that you need to do going forward to benefit from this current housing crash, which we can clarify and say it's transactions, but you're going to find the housing crash in price, because we don't need the market to crash that 9% to set a new record. We need where you invest to have a motivated seller, because the ones I've found so far, I don't know about the one today, but the ones from before weren't motivated. They listed at their silly price, didn't get it, so they left it on there. Some pulled it off and said, okay, I'm just not going to sell. We need the person who has to sell. You need to find that person who's got the life event that means I have to sell my property. Here's what I hope to get. And then it sits on the market. And in your area, it might be 20 days. It might be 30 days. It might be 4 days where you think, okay, my under asking price offer with contingencies, because here's some statistics that we've seen. Offers over asking have come down. Days on market have gone up. Mortgage applications have gone down, but there's a cheat there. 2 years ago, a lot of people were refinancing. That's a mortgage app too. Very few people are refinancing now because it doesn't make sense to double or triple your interest rate. Inspections have gone up. That doesn't mean more deals are happening. That means less inspections are being waived. So we're back into, with the sellers having a fear of missing out, not only might you might have better negotiation with the price, but you might have term negotiation. Seller financing might look more attractive, but it can also be inspections don't have to be waived. Appraisal contingencies don't have to be waived. You have more negotiating power once you're under contract. All of the things that we had to waive before, we're not having to do now. So where speed was your friend, here's the winner now. The thing that will make you win today. Patience. Don't be in a hurry. I caught myself at that this morning when I got all excited because I found the deal. I was like, this is the deal. This is the numbers. This is the area. This is the rent. This is everything I was looking for. Checked off all but one of my boxes. And I thought, I want to make this offer. Get that adrenaline rush. You get nervous. And I'm thinking, it's been on the market for over 10 days. Why am I in a hurry? Why did I reach out to my lender and then kind of mentally give him kudos for having that letter back within like 10 minutes? So if you want to use my lender, reach out to me. I'll connect you here in Washington. He's amazing. Why did I, with my agent, poor guy, email, text, call, like I was still doing it from the last 2 years? Because speed mattered, but it doesn't. Patience is what's going to win now. Like the 1.3 fourplex from over a month ago, I make my 1.1 because that's where it makes sense. I have since then resubmitted an offer with them at 1.3 with Michael Zuber's that he found from his lender on his channel. I love my memory. At 50-40-30, 50-40-10, where you 50% loan to value comes from the lender, 40% is seller carry, 10% is your skin in the game. I can't remember his name. Anyway, yeah. I forget his name every time. Stephan Dow. Ha! Yeah, Stephan Dow is the lender for him. That came up with that idea or pitched it with Michael Zuber, and then I've got that offer and still no response from it. But now patience is our biggest strength. And then the biggest mistake that I think people can make right now, well, patience is the key to help you win. The biggest mistake that an investor can make right now is the same one you could have made for the last 2 years. Doing nothing. Here's the key to where I'm totally comfortable saying there's a housing crash. And some trolls are going to say, but you've been saying for 2 years that there's no housing crash and that the other content creators calling for a housing crash are wrong. They were for 2 years. And so I think if 2 years ago somebody said there's a housing crash, wait for the crash or correction, and you listen to them, you should probably sue them because you lost out on 2 years of cash flow, pay down, gains, all of the things that have happened in those last 2 years. And some people have said, well, what if you bought at the peak? Great. Who cares? I don't care if prices come down. That means that the next one's going to be better than the last one because I'm buying for yield and cash flow. And if I got my yield at the peak, I'm going to get my yield on the way down, and it's just going to be a lower price property. My yield might increase over time, but as I find my yield going down, I like to think that when you invest in real estate, we can borrow from a stock strategy, dollar cost averaging. In stocks, the people who consistently buy a set amount every month or every day, like Jaspreet Singh buys this much Bitcoin every single day, whatever, over a long enough time. The people in stocks who dollar cost averaged performed better than stock pickers because nobody can perfectly time the market. So if you're trying to time the market, sure, we can look back at the last 5, 10, 15, 20 years and say, this is exactly when you should have bought. But most of us were alive that day. Why didn't you buy? Because we don't know. So yeah, I might have bought one at the peak. My friend might have bought one at the peak, but our yield is there. We have the cash flow from that because since 1914, and take this to heart, here's the thing an investor does worry about, not prices coming down because that means we can buy things on sale. Great. You don't, and who cares if the market crashes? You need to find the seller for your deal that needs the price to come down. Since 1914, when we started tracking the data, rents have never dropped for Class C and B areas. Now you do have some places like, Detroit where manufacturers and from one economic driver source move away, you have a rent crash. I totally get it. But as a market across the board, they've never gone down. In 2009, it looks like rents went down, but that's because they went down in Class A. And this is something where me and Jonathan Twomley actually have the opposite opinion. He likes to invest in Class A because he says in hard times, those are the people that'll make their rent. Well, as a proven fact, in 2009, those are the people who stop paying rent and move out because people can move to Class B or Class C to save money. Very few people will move to Class D. So in 2009, there was actually more demand for rents, and Class C and B went up because most of the people, and it was millions, who went through foreclosures became tenants, became renters, which increased the demand. But they weren't renting Class A. That's why they went through foreclosures. Why? Words are hard. Why they went through foreclosures. That's almost that's over 100 years of data saying that there's never been a rent increase. As a buy and hold investor, my portfolio is designed to take a 50% rent decrease and not make me have to come out of pocket. So I'm planning for a 50% decrease, but we've never even seen a 10% decrease. And I've never seen the rents go down in my areas. So there are, like I said, there are some markets where it's happened, which is one of the reasons why some of my strategies are to invest in small multifamily that are spread out close to several different economic drivers instead of buying one 10-plex to start with in one area. Once you have 10, 15 units and you want to buy a 10-plex, sure, because it's part of your portfolio, not the whole thing. Because if you have a 10-plex, you're probably drawing too many of your tenants from one local source that could move away, lay off, close, whatever the problem is. Mine are all different areas, usually all but two, because there's two, are more than 10 miles apart, close to a base, a port, a college, a hospital, a Boeing or Amazon terminal, a beach, something that would draw people there. My one house is at a lake. So that diversification and ability to take a 50% rent increase when I've never seen a 10% makes me sleep like a baby. For the last 2 years, I've been saying, and here's why I'm okay with saying there is a housing crash when I was saying that there wasn't. For 2 years, I've been saying, hunt for great deals, take action, buy the property, get on the property ladder, get to 4 properties from Michael Zuber's book, One Rental at a Time. Life changes at 4. It's when it changed for me. It's when I reached lean fi, when I first had those first 4 properties with 7 units on them. What I'm saying right now, today, during this live stream, where I'm calling this a housing crash, is going forward. Find good deals, buy the property, hunt for your yield. But we're shifting how we do it. That's the reason why this is important. 2 years of speed, 2 years of waiving contingencies and offering over asking, to patience. Hunt for the motivated seller who's been impacted by days on market. I'm going to get to the questions now. And I really want to thank everybody who's come to hang out for my live streams. This is like my therapy. No one in my real world that I talk to, not no one, probably 5 people total, invest. And almost all of them invest in real estate. But I want to share this information with somebody and help them reach financial freedom. I want to help you reach financial freedom for a very selfish reason. I'm going to share that, and then I'm going to get to the questions. 11 years ago, I was in a really bad financial position. I had made it to 40 with pretty much out ever having $1,000 in the bank. Found out about a bunch of bad debt in my name during the divorce that I didn't know existed. 1 custody, so single parent, 3 kids, had been laid off from a police department. I was making $17 an hour at a truck driving school. Was not in a good position to start investing. But I got to transition to the point where I am at now. 16 rental units, hunting for the next one, financially free for over 4 years now, work because I love my job, not because I need the money. I can only do it once, right? I'm not going to give up my portfolio so I could do it again and experience it again. But I get to experience it every time one of you, or that person right now that's watching this video, when you reach financial freedom and you share with me your journey, how you did it, and maybe how my information helped you get there. I get to experience it again. Like that's amazing to me. Let me come up here to the chat. And remember, this lasts as long as the questions do. And I think some questions came in before we went live, and I appreciate that. So what I like to do is I like to put the video up a day in advance. So if you see it on there, you can actually go into the chat, the live chat, and put a question in before we go live. So if there's somebody in Futureland watching this, because you couldn't make the live stream, you can get your question answered during a live session by putting your question in before I go live. And because I plan on eventually, when I figure out the tech or hire a 10-year-old to do it for me, putting these into a podcast format. And a lot of people watch YouTube, with the app closed. I read every comment that comes in. So even the trolls that are probably going to show up because I've been talking about no housing crash for 2 years, and now I'm pivoting saying during this housing crash, here's what you need to do. And I'm okay. Trolls make the world go round. Dan Hunter, howdy. To escrow or not to escrow? That is the question. What do you do with your taxes and insurance? Pay yourself or roll in mortgage? Pros and cons. During a period of time where there are super high interest rate savings accounts like the 70s or 80s, when you can get 11% in a savings account, or however that worked back then, when it doesn't happen now, it might have made sense to keep your money and have it into a yield, something that had a yield, and then make the payments. I escrow everything, and up until this last month, it's never been a problem. Monitor, call go to your insurance website, make sure it's paid. Call your county tax assessor, make sure your taxes are paid. I finally had my first mortgage company too, because they bought it during October. They sold my loan from one company to another, messed everything up. Taxes didn't get paid, insurance didn't get paid. Then when insurance did get paid, they did lender placed insurance, which was like 4 times what my quote was from my insurance, which was a better policy. I escrow everything, but verify. It was like Reagan: trust, but verify. Make sure it's being paid. So if you don't want to escrow it, I do have one paid off property, so that one's not escrowed because there's no mortgage. Auto payments. I have my Stillwater insurance through Geico that takes out exactly monthly for the homeowner's insurance, and then my county tax assessor takes out half in April and half in October of that tax for that property. So I automate everything because maybe you have an amazing memory and you don't ever mess anything up. Not me. That's not my thing. So I like to automate as much as possible. Check with your lender. I don't know if it's because not everybody is watching in the same states or in the same type of situation. If a lender charges a fee for it to be escrowed, or your insurance charges to be paid on payments instead of all at once, or something where it would make sense, or you could save money to pay it yourself, then that would change the metrics. But my insurance, it doesn't matter if you pay it per month or all at once. There's no discount. Same with taxes. So Tom, howdy. Jimena, hola mija, ¿cómo está? Excited to watch this live. Nice. Kelly, howdy. Hi, I'm getting pre-approval, but this lender wants to charge me up front to pull my credit. I have never had a lender charge me for a credit pull before. I have never had one pull your credit before. I know that it's the only thing that they're allowed to charge before giving you a quote. They can charge to pull your credit. Depending on how they're doing it, the fee might be $40, $45 or less. If it was more than that, I would freak out. It could also be that the lender doesn't feel confident in your ability to follow through, because they do have the expense when they do that. So they'll usually run your credit if they're confident you're going to do the deal with them. So maybe check with other lenders first. Yeah, that's an interesting one. Jack, howdy. Has it been a week already since the last one? Yes, time does fly by. And I'm hoping that this time my Wi-Fi is working better. I basically hired a teenager to come over and set the router up better. That sucked last week. It's the first time I've had internet issues here. Loco Eddie, howdy. Thinking of building my primary and adding an ADU, then keeping current one as a rental. The question is, do I jump to the build now or buy another live-in rental first? This is very specific to your situation, your area, how your municipality handles ADUs, whether they're friendly to it, whether the process works good. I recommend checking out a YouTube channel called That ADU Guy. Ask him questions. In his videos, he puts his phone number, so he'll answer text. Like, the guy's awesome. He might have some information that could help you there. I kind of am interested in building an ADU, but I'm also super lazy. I don't even like doing rehabs. I like to buy a place that has a tenant in place, get the tenant to request a rent increase, and then just make money off the property. So I would lean towards buying the next rental. But if you're going to build the ADU, you might be able to get a better yield. And there's some really cool things to think about with ADUs that ADU guy will explain. Whereas let's say you wanted to build a house, and you would think there's a 1-bedroom, 2-bedroom, 3-bedroom option. 3 bedrooms is going to get the most rent, but it's not going to get the best yield. The increased cost of building that 3 bedrooms to have the square footage to do that and the plans and everything that it takes to get to that level, the increased rent doesn't justify the decreased cost you could get if you built a 1-bedroom, and in some cases a 2-bedroom. So that ADU guy can answer that question best as to if you were going to build an ADU, which is the size that's going to get you the best yield. Let me know how it goes. Dan, Meowdy. Do you know what homeowner has a meow in it? No one can ever see that again without saying it that way. Doug, howdy. 9.9K subs, maybe 10K today. I don't know. I get like 20 to 30 a day. So maybe I hit 10,000 subs. Maybe not. It feels weird to hit 10,000 because that's when you are no longer a small YouTube channel. You're actually labeled a YouTube channel. And my goal was to have 200 or 300 people watch videos that I can make to answer a couple questions from the Facebook groups. So nailed it. Doug. Pallavi, howdy. Good evening. Homeowner. Yes. 8 years as a police officer. I believe every cop, Millennial Mike, back me up on this if you guys ever did or not, but the meow during a traffic stop, of course. And we had cams on chest. So end of shift, when you watch the best outtakes from the day, we would do that. Laura, howdy. Thanks for stopping by. Vatsal, howdy. I am almost marvelous. Michelle, howdy. Selling a rental to use proceeds to buy multifamily. The agent wants to show what transaction is closing for. You said no need to do that. Don't want them knowing how much money I have. What to say? Seems like agents think she's paying cash. All rents are going to be net, so buy anything. See if I can understand the question. Selling a rental, using proceeds to buy multifamily. The agent wants to show what transaction is closing for. To who? Huh. Is it? I'm not sure I understand, Michelle, on who they want to show it to. Seems like agents think you're paying cash. All rents are going to be net, so buy anything. Yeah, no, that you can figure out your yield, and ironically, your yield usually goes up if you use leverage. Yep. If you could, I'll put my email in the chat, Michelle. Email me like a lot of details, and I'll go in and I'll because you might not want to share all of those details here. I'll try to give you the best answer I can. I'll put my email in the chat in a little bit. Laura, Dan Hunter, I prefer to keep the money in my pocket. I pay the taxes and the insurance. Good. Cool. Samo, howdy. John Roberts, howdy. This channel is educational and is very educational and helpful. I watch as often as I can. Me too. Thanks. I appreciate that. Dan, separate account to keep better track or with your savings. So we'll see what Laura says for that. Here's what my bank accounts look like with 16 rental units. Self-managed, long list of reasons why. One of them is coming out in a video soon on people not understanding top line, bottom line. But one checking account, one savings account, one credit card, one Excel spreadsheet with a tab for income and a tab for expenses. I send to the CPA, I sleep like a baby. You might have to keep deposits in a separate interest-bearing account based on where you live, so check that, but that's it. So the mortgages go out of the one account, the rents go into that account, the property that I cover the insurance and taxes on comes in there. I don't need the confusion of having more than one banking account, one checking account. It just doesn't make sense. If you run your numbers close enough to where it would matter, or you need a mortgage to come in before the rent's going out, I think that's way too narrow on the margins. So you should have enough in that account to where all of those things can happen way above where it would ever be an issue. Like my savings and my reserves and all of that, and my money invest in the next property are all in one savings account. There's no reason to separate those out. For me, that ADU guy, days on market. Howdy. Thanks for stopping by. William Kraft. Howdy. How's it going? Selling your house next month and getting an Airbnb. Nice. Cool. Good luck with that. Let me know how it goes. Lumberjack Landlord. Howdy, Matt. Giving all great content as always, folks. All he needs is a like button to be pressed by anyone getting value out of his work. So that's one thing I like to do different is if my content helps you, if I earn it, hit the like button. Chester, howdy. I want to send Zuber your buy box and analyze on a Zoom meeting like this past Saturday. Email him. He might do it. He's pretty open to doing interviews with people because viewers like to watch more people to see that it's happening. William Kraft, thanks for being here for Lumberjack. For y'all's joint content, me too. And then my chat moved, which I like, means people are talking. Jack, the silly price. Yeah, right, the silly price. That made sense. People were paying the silly price for the last year. That fear of missing out was so strong with buyers. That's where the over asking would come. They would list a silly price and then the over asking would come. William Kraft, I had an appraisal contingency with a 10K gap and saved 20K. Stephan Dow. Yes, that's right. Thank you, Chester, with Velocity Mortgage. William, right. So that's another strong thing that you can do if the pendulum might not be all the way over to a buyer's market yet. We're moving there. But instead of waiving an appraisal, you could have an appraisal contingency and say, but I'll cover 5, 10, 15, 20,000 gap in appraisal, whatever makes sense to you, that you have the money that you can do that you'd be okay with, depending on how the appraisal comes in. Yeah. Rob, howdy. What'd you miss? Just the best relationship advice I think I've ever seen on the internet. Just, later watch the first 10 minutes of this video. That was what. Clinton, howdy. Is that one map or do you have multiple different maps? I have 1, 2, 3, 4 different maps. Four maps. Some duplicates because where do I get them from? Their ordering is not so great. And but they're great. When they send the wrong one, they don't say send it back. They just say, oh, we'll send you the right one. So I've got a couple duplicates of this one. This is the Forgotten Realms. I've got Cran, 2 different ones for Cran, and 2 or 3 different ones for Forgotten Realms. They do a few things. 1, it's hard to tell if I'm at home or at work. 2, they help with the acoustics so that I don't get no real canny sound with my voice. Because audio matters. Joel, howdy. Just like a dividend growth stock. Exactly. The dollar cost averaging. Yep. Hayes, howdy. Cheers. Rob, the Fed has proven that they will inflate with reckless abandon long before they allow prolonged deflation. I don't know if they proved it on purpose. It's proven that it's factual, but I don't know if it was intentional. Rich, howdy. The Leviathan, howdy. Supernatural fan. I bought a duplex on FHA 2.5 years ago and refinanced to conventional. Now I want to buy another duplex with FHA in my area, but I'm having problems. Is FHA an invalid vehicle for building a portfolio? So it's good for small multifamily, especially triplex or fourplex, because you can do the 3.5% down. I would prefer conventional for a couple of reasons. 1, it's easier to get sellers to accept. 2, you might have to lender hunt, but some lenders will do 5% down conventional on a duplex. They'll do 5% down on a single family or house with an ADU, so you can get 2 like a duplex. And I just did a deal deep dive not too long ago with Kevin and Britt. who purchased a duplex with a 5% down conventional through a local credit union. So you might have to lender shop. The problem with FHA is the reason why the lumberjack landlord strategy of 4321 is so good is because with FHA, they don't want you to use it to build a rental portfolio. So when you buy a fourplex, you can move towards a single family or to a larger single family. So if you have a fourplex, you then buy a triplex, then you buy a duplex, then you buy a single family. And FHA usually doesn't have a problem with that. Once you have a single family, you move to a larger single family. You can have other things too. This one's closer to work. This one's in a better school district. You have to have articulable facts that justify why you need to move your primary residence that the lender goes along with. And lenders aren't all made the same. There are some who will do FHA and don't care at all what your reasoning is. And then there's other ones that are like, nope, you're trying to build a rental portfolio. So lender shop there. Lenders are not all made the same. Lenders aren't made the same this week compared to the same lender next week. So FHA is a good vehicle to do it. If you can qualify for conventional, which means you need to have a little bit better credit score, a little bit better debt to income ratio, and mortgage insurance drops away automatically when you hit 22% interest. So there's a couple benefits to conventional: easier to get accepted, doesn't have the problem of you need to be moving towards a single family or to a bigger single family or justify why you're doing it. But there are some reasons why FHA might work if your credit and debt to income require it. Lender shop and come up with a reason why you want to move to that area. Congratulations on the duplex. Let me know how the next one goes. William, this is your first. Love it. Awesome. Thank you. I'm glad you're here. Nick, howdy from Texas. Amancio, howdy from the 808. I have no idea where that is. 808, is that East Coast? Indy, howdy. Joel, the only time I saw rent and real estate prices decrease simultaneously was 09 crash. You didn't really enjoy your content. Thank you. Yeah, so in some areas it did. In a lot of areas, Class A did go down in 2009. But in my area, in 2009, rents went up. There were just more renters. There wasn't enough units. Yeah. Ronnie, howdy. Can you tell us a little bit about the deal you are doing? What are you doing different now than 6 months ago? I can't give too many details on the deal that I made the offer on today because it's listed on the MLS. And if I share details, it'd be really easy to find. And other people might run the numbers and make a better offer than mine. So in a week, when I either don't get accepted or I go under contract, then I might share details. The number that the seller has on the listing doesn't get me the yield I would want. So 6 months ago, I would have passed on the deal. I wouldn't have even looked because it would have been gone in a few hours and it didn't get the yield that I wanted. So making an under asking offer wouldn't have done me any good. It would have wasted my agent's time and it just would have sold. What I'm doing different now is it's been on the market over 10 days. So there's not 15 offers. They're not over asking offers. So I look at the numbers. I figure out the number that makes sense to me. It is lower than they're asking, but it's not massively lower. So it's not an insult or slap to them. I don't have to explain to them my mentality. It's just lower and a little over 10 days on the market. So I made the offer. I had to train myself. I'm not in a hurry. I just want the offer in. I want them to know if they're a motivated seller, if they need to sell, my offer's there. And normally what happens is, in this case, it's been on the market for over 10 days. I make my under asking price offer. They're going to respond with, weirdly, magically, we got 3 or 4 offers today, so we need your best and final. And my best and final will be resubmitted at exactly the same amount because they don't have any other offers. They would have had them 4 days ago or 4 days from now, not today, not at the same time. So now I sit back and we play the waiting game. They are either a seller who had a silly price where it made sense to sell, so they leave it on, or they pull it off because they're embarrassed that they're not selling, or they need to sell for some reason, some change in their family or whatever the reason is that I might never know. And they come back and they say, here's my counter, or we accept your offer. And then I go through, I have an inspection contingency. So I go drive by the place. I know the area. So I know it's not near McNeeley Avenue in Tacoma where you just don't go. Like if the cops can't go there by themselves, you don't buy there. This isn't an area where I would go, where I would like to own property. Like I said, it checked off every single one of my boxes except for one, which I'll explain next week. That's what I'm doing different now. The days on market is my strongest negotiating tool today. Probably even stronger than the inspection report will be, because I'm not really worried about negotiating the price down from the offer that I made, because I get my yield at that offer. The things I'm doing the same from 6 months ago is tracking area average rents, not quite daily, but 2 or 3 times a week, and not by rentometer, not just going and saying, oh, this is what historical data said. I mean, apartments.com, Craigslist, Facebook Marketplace. Today in that area, if I was trying to rent that unit size, that many number of bedrooms, what would it cost me? Knowing that, so I can know what offer I could make and get my yield. Checking interest rates almost every week to make sure that the offer I'm making, I know what my interest rates will be with my lender, because, and I'm going to talk about this in a video that's coming out Thursday. I might even do it live so people understand its stream of consciousness. Interest rates went down for the last 2 weeks. Even after the Fed saying they're going to raise rates, raising the rates twice, and saying they're going to raise rates more, borrowing from banks, rates went down for the last 2 weeks. Knowing that currently lets you know what you can make your offer on. Yeah. Thanks for that question, Ronnie. Ultimate bargains. Howdy. It's different this time. Where have you heard that before? Larry. Howdy. Sorry, Ultimate, you caught me. Where have I heard that before? Seller's market. You have to find and make offer fast. Buyer's market, wait for sale listings and submit low. Great offer for you, and let the best motivated deal come to us. Great summation. It's perfect. It's absolutely true. Or it's how I see it. So I don't know if that makes it true. It just makes it how I see it. So we agree. Cam. Howdy. Dion, just wondering if you can discuss about subject to topic. You and Michael have discussed a lot lately about buying deals with great terms. Thanks. Something that I would borrow from the lumberjack landlord is find out what matters to the seller. Knowing things like how long have they owned it, how much debt do they have on it, do they refinance, do they pull cash out, do they have a huge mortgage? So seller financing isn't an option. Why are they selling? Are they interested in, as we get into finding more motivated sellers who maybe don't have the equity to sell, which would be really hard because we've had so many gains in the last 2 years. But if they purchased it 100% financed, owner occupied within the last 6 months, and now they just can't afford it for some reason. Subject to is harder to get lenders to agree to when the current mortgage is such a significantly lower interest rate than they would get on a purchase loan, because you have to get the lender to agree to it. You can do seller carry where the mortgage stays in their name and you just pay it, but I don't understand that well enough to know that I could even say that it's a strategy I would use. Maybe that's a Michael Zuber question or a lumberjack question, because I haven't done that. I tried to do subject to when I was underwater on my house, and I found a buyer, and the lender told her credit wasn't good enough. They would let her take over my mortgage if she made 1 year worth of payments to me and I made the payment. And in a year, then they would put the loan in her name. So lenders are very unique when it comes to that. At 10 months, she quit one of her jobs and couldn't qualify, and then became a tenant, and then later inherited a house. So she still ended up on the property ladder, just through a different path. Yeah, subject to is interesting. You're basically finding somebody who's trying to get away from their house, who doesn't have the ability to sell. So they don't have either enough equity to cover agent fees, or they're underwater. They owe more on the property than it's appraising for, which is the thing I said where it'd be really hard to find that, because in the last 2 years, we've seen so much appreciation. Some specific markets, it might be possible. And like I said, 100% financed in the last 6 months, it's possible they might be underwater. But that's when subject to makes sense. It still has to make sense to you. The purchase price and the payment are going to be at a minimum usually what the previous loan was for the owner currently. And so you have to be able to find your yield there. That is a great topic. I think that would be a good topic for the three amigos, because I can ask questions and then the two of them can educate me. That'd be great. Ultimate bargains. The housing slump is just a slowdown. It's not a housing crash until the supermajority of realtor listings include phrases like make offer or bring all offers. So Redfin has announced some information. Where did I see? It was literally the thumbnail in Michael Zuber's thing. This is the percentage of listings that lowered. So it's not how much they went down, it's the number of listings, a percentage that lowered their list price, which again is wish prices coming down. So technically, yes, it's not. If it's dropping back to last year's prices, is that a crash? And ultimate, you watch a lot of our content. So me and Mike and Matt, we've been railing that there's not a housing crash coming. But what's hurting us is we're saying there's a crash in transactions happening. And there is. That is factually happening. There are less deals being made. So we're correct when we say that. We're trying to say that and say that there's not a housing crash in prices because it's transactions, right? So it's making people not watch our content because we're just trying to clarify something that doesn't matter. What really matters is with the crash in transactions, what are we doing different? So who cares why we call it a crash? It's a crash. We're just going to leave out the in transactions and we're going to say in the current housing crash, patience is how you win. Watch days on market, find the motivated seller. These are three things we were not doing. You couldn't watch days on market when you had hours before under contract, right? So that's what I'm doing, and I think Mike is doing. Matt may come out this Thursday with the Three Amigos, and we might just go head to head, and he tries to prove there's not a crash, and we try to prove that with what we're calling a housing crash, here's what we're doing different. Don't know if that's how it's going to go, but I would totally understand because Matt is firmly like you. It's a slump. It's a slowdown. It's not a crash. But what is he doing different? And I don't know if he's doing it much different because I think his buy box in his area went from 1 to like 5, right? In my area, it went from like 40 to 130. Like I was looking this morning and I was filtering out deals quickly because I had to get down to the ones that I would actually find a good deal in. There's so much inventory now, which 2 months ago, I was like happy if I got 10 to look at. Yeah. So area specific too, though. Suyash, howdy. How do you decide if I should buy a new construction or older rebuy? Looking for my first investment property and scared of unexpected expenses and older rebuys. No DIY experience. Thank you. So I don't do any of the work myself. I would find a couple local handymen, which you can find at local REI meetups, and don't worry about not being handy because you don't need to do the work yourself. New builds generally don't cash flow as rentals for 5 years to 10 years. Like they just don't. The cost of doing a rebuild, what the builder needs to make, it's possible if you have land and you do a build on it, but the cost of the land and the build is usually going to make it not cash flow. My properties, most of them are from 1980 to 1992. So it's a 12-year window where most of my properties are from. And I buy that need one time I bought one that I knew needed a roof. Most times I've not spent more than 1,000 or 2,000 getting them to going. My strategy is specifically buying rent ready or already occupied properties. I have one that was built in 1929. I have no idea. It's one of those two. I think it's 29 because it's not 100 years old yet. So 1929. I'll have to look that up sometime. I've had an HVAC issue there that cost me like $500, and I had to have one septic line hydro cleaned, whatever they do that when they hydro jetted. That's it. That's all I've spent on that property, and that doesn't need any other work. So age of building to me doesn't matter as long as I have the inspection done, and I know that I don't have things like knob and tube wiring. The plumbing's been updated in the last 20 years, maybe 30 years. Your inspection is going to give you a to-do list and tell you whether you should pull out or not of the deal. And I invest for cash flow. So I don't even look at properties. They just don't show up in my search because of the yield I'm looking for. So the newest one I think I've even looked at was built in like 2005-ish, would be the newest. Anything newer than that I've seen is so expensive. The rents are so far behind, it isn't going to cash flow for another 5 years or so. Yep. But you're in the right place to find, especially watch Matt, the lumberjack landlord. He's got a bunch of, here's how he does rehabs, here how he gets materials, and he doesn't do the work himself. He has contractors do it. And it's like when you buy a property, you have an expense that's going to generate income. So you have a yield. You're going to have repairs that some of it is part of the maintenance or upkeep. Some of it is an improvement, like adding a wall to make a third bedroom instead of it being a 2-bedroom. How much is that expense versus what is the return going to be? It's all kind of math on that level. You don't need DIY experience. I actually think DIY investors sometimes do worse than regular investors. My brother has 10 paid off rentals. He retired at 50. He's been retired a little over 7 years now. So he's killing it, right? But he did all the work himself. He would buy mobile homes that were falling apart on acreage, and he would buy them great price because he would just, nobody else wanted them, right? And then he would do all the work himself. So each new rental represented 2 to 3 months of sweat equity labor, and then focusing to pay off the home equity line of credit he used to buy it. So while he was doing that, he was working 10 to 12 hours a day in his business, 5 hours a day or so on his rentals. I thought he was going to kill himself. And then when he finally retired, he shut down the business and he had the 10 paid off rentals. I get his plan now. But I thought he was insane those years he was doing that. I'm trying to think. So I've painted one of my units. I've swapped out a sink. Like there's been a couple. I've worked next to handyman because I was like, okay, I've never worked on a deck before. How does this work? But not because I needed to, because I wanted to learn it. There are contractors, and you can use this thing called and this you might want to take a note, Thumbtack, like Thumbtack app. Thumbtack is one word. It's a great way to find contractors, get quotes, read reviews. You actually get to read reviews from others who've used those contractors. And this is for plumbing, electric, fencing, roofing, doesn't matter, tree trimming, whatever you want to do on that property, you can find the contractors, get quotes and emails in just minutes, read the reviews. And the really cool thing is I've had really good luck with the Thumbtack app because, and they're not a sponsor of this channel or anything, which I should reach out to them. Because I'm hitting that 10K mark and people start to let you be sponsored for that. The contractor knows you're going to leave a review when the job's done. So I've had really good luck with the Thumbtack app because, and they don't give you a super great price because you're going to leave a comment, but they're timely, they're responsive, they're communicative, so there's all the things that matter to me with a contractor, and you get prices that you can compare. My fear wouldn't be, I don't have DIY. My fear would be relying on your job for income. Every time you get a couple of rentals and you get those more streams of income, all of the worries that you have right now, you'll still have worries. They'll just be new, different ones. Angel R. Howdy. Thank you for this. Thank you. Tiffany. Howdy. In Brandon Turner's book on managing rentals, which I have a copy of right here, in that he talks about how landlords should have a key box for organizing the keys to rentals. How do you manage your house keys with having 10 plus units, rentals? That's a great question. Thank you. There is a video on my channel called The Locks I Use on My Rentals. On the note, I don't have keys for any rental, for any unit. I don't organize them at all. I have coded locks, Schlag coded locks. I'll put a link in the description below of this video when we're done with the live stream. So I'll pin a comment to the top of the locks that I use, Schlag coded locks. So they're a little bit more. They're like, $90 to $110 instead of $30 for your locks when you go to put them in. So it costs a little more originally to put them in. I have a code for me, a code for contractors, a code for tenants, a code for handymen that I can switch out on anytime I want. I can go and reprogram and take codes out or put new codes in. 2 exterior doors, so I put in 2 coded locks. I've never had a tenant lock out because the odds of both batteries dying at the same time are so slim because one door is primarily used more than the other. And I've had locks in those codes, and the locks that I use specifically, the batteries last more than 2 years. So not the ones where it engages the mechanism or not, where you put in the code and then you have to twist it. Those batteries last for a couple of years. Not hooked up to Wi-Fi, those last a couple of months. The ones where the motor goes in and out, those last less than a year. So I have specific ones that I use that are very reliable. I think with 16 units and over 10 years of investing now, I've had one lock that didn't work when I put it in, and they just sent me a new one. Schlag, Schlage, coded locks. And like I said, I'll pin a comment in this video when I'm done. That's how I manage my keys. And I think they come with keys. I've just never kept them. I don't even bother. Um, I have had people say, isn't it risky to give a contractor or handyman a code to your place? Well, yeah, you could check the code out. But if a lock can keep your contractor or a handyman out of your property, you need to find new employers or new companies to work with. They should be able to get through a lock fairly easy. That was a great question. Thank you. Ultimate bargains. I had a lender charge you $15 for payoff letter when I wanted to refinance out of that loan to a different lender. They later refunded that charge. Interesting. So I know the only charge they're allowed to do before giving you a quote is your credit. But if you already have a mortgage with them, it probably negates that rule. Michelle, you need a mentor. This next month is going to be different between Fi now or in 2 years. Okay. Tiffany, he says, and in his video, he changes locks for digital ones. Yep, thank you. And then Everlasting Flow, howdy, took back 2 messages to make me lose sleep tonight and wonder forever what he took back or they took back. I'll never know. It's the small things in life. And I am going to need a drink. Tonight's video sponsored by, as per usual, Alien Vodka, which seems to be lower than it was last week. Not a sponsor, not really a sponsor. Finding a mentor. I have a video on my channel on finding a mentor because a lot of people will go on to forums, BiggerPockets, Facebook, whatever group you're in, looking for a mentor. To be a barber, to build fences. If you're going to invest in real estate and you want to be really specific, you're literally in a Facebook group, to wholesale, to flip, to burr, to do storage, to do short-term rental, long-term rental, local, at a distance, like all the options that are out there, nobody can be your mentor. When you narrow down what you want to do, and you do that, I think, by watching a lot of podcasts, BiggerPockets. And so if you're investing in real estate, which I'm guessing that might be why you're on my channel, One Rental at a Time, Lumberjack Landlord, Matt the Mortgage Guy, Millennial Mike, like there's all these channels where we share information on how to do this. And then you pick a strategy because I can't help you wholesale, flip, burr. Like I got the concepts down, don't do those things. So not a pro, shouldn't give advice. Just like relationship advice. Don't come to me. Except for Rob, beginning of the video, the part that you missed. Once you know what you want to do and you learn the basics, the mentor shows up. I always say, when the student is ready, the teacher arrives. Well, the student needs to know, here's what I want to learn. I've got a baseline. Because when someone comes to me and says, I'm looking for assistance, I have to start with some really basic questions. Where do you live? Where do you want to invest? What asset type do you want to invest in? What are your goals? Like, here are the questions that lead us to, can I provide you any information that's going to help? Or can I say, here's the list of books you either need to read or listen to. Here's the podcast and maybe some specific numbers that you need to watch. Once you have that basic core knowledge, we can build on it. And that's where your mentor is. Right now, the mentor that has done what you want to do, that's willing to share the information, is waiting for you to show up with the core knowledge, to ask the right questions so they can build on your knowledge. Because they can't make decisions for you. A mentor can't tell you what your goals are, what your timeline is. Like that all has to come from you. And once you have that, then it's easier for the mentor to be able to help. Jack. And my chat moved. A lot, which is great. I really appreciate the questions. You guys have no idea. I want to do a live. I want it to last 3 hours. I want to give quality content because I'm trying to make videos. My videos where I cover a topic, I want to be 10 minutes or less when possible. My interviews where I have a guest on, I want to be around 20 minutes, kind of ish. That ADU guy, we like literally connected. Why haven't we not done the video? Remember, my memory sucks. I'm asking you, reach out to me to schedule that. That should be like a couple of 20-minute videos where we can go on each other's channels and help people. But my live streams, I have a couple short ones, but I want these to be long for those people who are like, I want the information. I need to reinforce my take action mindset when they're driving, when they're doing work where they can listen like this. So each question that you come up with does a few things. Helps me have a longer live stream because you don't want to hear me just ramble for 3 hours. You want me to actually answer questions. And the questions you're asking, tell me, here's content I need to cover, or here's something I hadn't even thought of that I need to research. So I appreciate each one of these questions. And I'll scroll up to where the taken back questions were. Jack, I've been doing the work since mid-April and currently been sharpening my buy box. Good. I'm looking to invest in the suburbs of a major city, so I've been watching listings every day by suburbs. Some of the suburbs only return 1 or 2 properties in order to get to 20 to 40, as Zuber suggests. Am I on the right path of combining multiple suburbs into my search? Or would you recommend that I focus on one major suburb that returns 40 units? I don't know if you're only getting 1 or 2, that would be 20 different markets you were trying to look at. So that would be a bit harder. What I try to do is you have an urban area. So city of Tacoma, city of Olympia, the black hole of city of Seattle. So I don't want to buy in the city limits. Too many rules, too many restrictions, too many people. Because working in law enforcement, I know that out of every 100 people, there are 3 sociopaths and 1 crazy person who will kill you for no reason whatsoever. That's a lot of 100 peoples in a city, right? So I don't want to be near there. Draw concentric circles that go out like a pond. You drop a rock in the city, how far out do those circles go? At some point, you're going to find a band where the prices and the rents line up with what you're wanting to do. So your market might be a circle around the city of Tacoma. And if you go around this, we got the Puget Sound. So I'm not looking north of there, but I'm looking Graham, Yelm, McKenna, Lacey, like this circle around Tacoma, this circle around Olympia. That would be the markets that I look at. So instead of looking at 40 all over to come up with, aggregately the number that you're looking for, draw a circle and have your search set up in those zip codes or in that areas. And, maybe you get extra because you want your agents to send you more than what your criteria is so you can filter down, because you don't want them possibly filtering out a deal that you would have went for. So give them looser criteria than what you want, and then you filter down to that band. Maybe put a map on the wall, put a little stickers on there where the properties are, and then you slowly eliminate down to that band. And the further out you go, the more commuters you get, the more working people that you get, the more, whether you're class C, B, or A, or whatever you're looking for, it'll be based on the city that's closest to you, how far out that circle goes. And then you'll have, like, if you're looking at Colorado Springs, you can be like, okay, here's my circle, except this is a mountain. So there's no circle over here. So I've got a horseshoe on the other side I'm looking at. How far out does that need to go before you hit the price point in rents and properties where you can find your yield? That's how I would do that. I hope that made sense. Made sense in here, but words are hard. Cost of living. Howdy. That's funny. Show to the new seller she is buying from, my understanding. Show to the new seller she is buying. Oh, okay. They're going to find the information out online anyways in about a month. Don't know that it really matters as long as you don't think it hurts your negotiation position. Yeah. So there's a lot more details. And like I said, I was going to put my email in the chat. So send me like details and I can give you my actual thoughts on that. Daniel, howdy. Larry, since rents have greatly increased past few years, are you allowed to request security deposit raises that matches or updates the newer rent levels? You probably can, depending on your area. Check your local laws. I wouldn't do it. Doesn't matter to me. I want my security deposits on my rents different. I either make them $200 or $300 or $200 or $300 less. The main reason is I don't want the tenant thinking they've paid a last month's rent. So I don't want the deposit close to the rent amount, because I don't collect last month's rent. Some areas they don't even let you. I don't want tenants thinking that they have a free month's rent contingent upon them moving. That encourages tenant turnover, which is one of the most expensive things for landlords. So I set my deposits and they stay there 20, 30, 40 years, wouldn't matter. I haven't owned properties that long, but I wouldn't change deposits. Check your local laws to see if you can, but I think if rents have gone up enough, you probably could. I would be more interested in using the binder strategy to get the rents to the highest amount that I could while having happy tenants, without then also charging them a deposit, which makes slightly less happy tenants. There we go. Danielle, it was a pleasure to meet you at the Northwest Action Summit in Portland. Thank you. It was awesome to meet everybody there. I had a great time. I think we met. We didn't get a chance to talk much. So my email's in the chat. Reach out. Sam, howdy. Michelle, to the seller of the multifam property. Yeah. So again, I would just wonder if it's going to hurt your negotiation position, I wouldn't want them to share it. If it doesn't hurt you, it might just make this, I don't know, maybe the agent sees some reason why it's going to make their job easier. Danielle, howdy. Great time to buy. I totally agree. I'm so excited about the next 6 months to a year. Wish we had the funds. We got married last year and now we're trying to save money for a multifamily. The area average are about $350,000 for a small multifamily. They were that when I started investing here. Now they're 500-ish is the average. I know you're married. You've been married a year, so you're still honeymoon phase. Consider house hacking. What would it take for you guys for 1 year to live in a small multifamily? Fenced yard, house with an ADU, something where you can have totally separate living areas. You're not sharing room space. For 1 year to increase your rental unit count and your cash flow. Literally $1 million property, 3.5% down is $35,000. So it's not like you need to save $100,000 or $200,000 or $300,000 to get into a property. $350,000, 3.5 or 5% if you find the lender is a lot better than 20 or 25% on investment where you don't live. And yes, house hacking might not be everybody's cup of tea, but you're not doing it forever. You're doing it for now. 1 or 2 years of not the best life ever lets you live the life no one else can. That'd be my suggestion there. Ultimate Bargains. Question. What are your thoughts on for sale by owner listings that says price not negotiable and no buyer agent commission? I only so far have worked with agents. So if you're comfortable making an offer on your own or paying your agent out of your pocket, sure. It's all math. It comes down to, does the price they have it listed at make sense? And they say it's not negotiable. Days on market. How long has that been for sale? That negotiable happens later. Find that motivated seller who has to sell. Also, price isn't everything. Sometimes you can negotiate terms. Price isn't negotiable. Okay, would you do owner financing? How about 30-year fixed rate loan, 0 interest? But you get the price you want, or $10,000 more. What can you negotiate that makes the deal work for you, where you get the yield you want and it becomes a great deal? Everything a seller says is a wish list. And the longer it's on the market, the less power they have in those wishes. Never negotiate down your agent's fee. Like, I want my agents to make money because every now and then they're motivated to find me the next deal. I've had my agent call me and say, hey, I know we've got our auto searches set up, but look at this one here. Did you see this one, which I had gotten that morning? This checks off every single one of your boxes, like letting me know that was a deal I was looking for. Because the agent knows I'm not going to try to negotiate down their rate. I'm not going to try to get their work for a better price. I'm going to try to make my agent money. And referrals, like my handyman, my agents, my lenders, I do referrals. Whatever I can do to improve their business, believe me, in this industry, this is a finite set of people that you're going to interact with for the next few decades. All of that will come back to you. So even if you did, no buyer agent commission, it would come out of my pocket. Their commission would be part. I would just pay them, figure out the percentage, make sure they got it. Austin, howdy. What's up? Advice on finding out how safe a specific area in the city is. Post work time is limited and things move fast. Research advice to know if it's livable or recommend driving through area. I would consider calling property management companies and asking, I'm going to be looking for a property management company, which you might at some point in the future. If I invest in this area, what's your opinion of it? Would you manage a property there? If you know anybody who works in law enforcement in or around that city, you can always ask your cops know the neighborhoods. They literally have a chart in their department that says, here's where you need to go, like use the buddy system. And they're all listening to the radio comms all the time. And if somebody hears a traffic stop and they hear where they're stopping, they start migrating towards it. Or if it's in a better part of town, they don't worry about it as much. But there are certain parts of town that law enforcement knows. So if you know anybody that works in law enforcement, that's a great way to do that. Property management companies would probably also know. It's one of the reasons why I really think people should invest where they have that tactical advantage. You either live there or you used to live there, so you know the neighborhoods. You have somebody who lives in the area who somehow works in the industry, like a handyman or an agent or somebody like that, or a property manager who knows the areas to tell you, here's where you should avoid, here's where you should invest. I hope that helps. Rob, rent increases are crazy. The comps for my single 1-1 went from $1,500 when I bought it in November to $2,600 this month. That sounds about like my area. I have a place that was $1,130 2 years ago. Tenant just bought a house, so they're moving out. They're supposed to be out this week. So now they're doing literally prorated by the day until they're out. Area comps are $2,400. So I'm probably going to list a little under that. And it depends on if I do a full rehab with like new cabinets and whatever else I got to do, I'll get maximum area average rents. I'm going to look at it. I haven't seen inside it in a year. So if it looks good, I might just rent a little under area average and not do a bunch of work. I'll probably do some videos for that and some walkthroughs. Looking forward to that. But yeah, you're right. Rents are nuts. Sarone, howdy. Can you talk us through an example of how you find a deal and break down your numbers? Let me try to do that as simply as possible. And the problem with doing simple, it means it's going to be simple numbers. I find my deals on the MLS. I'm not doing mailers. I'm not going to county records and looking up who's an out-of-state investor, who's behind on their taxes, who's had a death in the family, who's all those like creative ways to find deals. I've never seen a wholesaler present me with a deal that made any kind of sense whatsoever. The wholesalers I've encountered basically have deals that are so overpriced they're embarrassed to put them on the MLS, so they're looking for stupid investors who will pay a price like that. I find my deals right on the MLS, but searching on the MLS is nuanced. I recommend not using Redfin or Zillow because the deals I've done, the properties I've closed on, show up on Redfin or Zillow a month or two later after I've closed as pending. That's how current the information has been. There are some people who list on there, but if you're going to find your deals on the MLS, at least that's how I do it. So I don't recommend Redfin or Zillow, not even to look at what a neighborhood should do. Maybe some historical data, but it's 3-4 months out of date. And look what happened to interest rates in the last month, 3 months ago. Absolutely irrelevant to what's going on now. I have at least a minimum of 3 agents with auto searches set up. If I had access to the MLS, if I was a real estate agent, I would still have 3 other agents with auto searches set up. I give them my criteria, which I have an email with basically these are the things I don't want. These are the things that I want. I shared it with Michael Zuber on his Zoom meeting on Saturday. It's towards the end of the video. In over 10 years of investing, I've only had real estate agents send me the same deal within 24 hours one time. That's how different. They take the same search criteria, set up their search, and I get different deals. After they've been on the market for 2-3 weeks, I start to see the same deals, but the first time they sent it, it's usually days apart from the others. So when they come to my area, to my email, you pick an area which you call a footprint. What is your market that you're going to invest in? And some people have a couple. You might invest locally for house hacks, and you might invest at a distance, like Millennial Mike. He house hacks in Seattle, but he invests in Gary, Indiana, because of the price difference, and he's able to make it work there. So he has two markets to learn. But house hacking, you're only buying one or two properties every other couple of years. So it's not like you need to be on that all day every time. It's just that, for a few months before you buy, you need to learn your market. So try not to have too big of a footprint because it's too much data to process, and try not to have too many markets because your brain won't handle it and you'll make a bad decision. So once you have your footprint and you have your auto searches set up, you need to know your areas that you would avoid. You need to know the property type you're looking to invest in. So house with an ADU, single family, split level, so you can do value add and divide it into two, or a build out basement, or whatever your strategy is going to be. 2-bedroom with over 1,000 square feet, because you could probably find a third bedroom in there to build something, whatever you're going to use as your metric. That's what the search is going to be set up for. As those come in, you need to be tracking a few things. These 3 things really determine what your yield is going to be. There are other things like, is there an HOA? How are property taxes factored in your area? What does insurance look like? Are you in a place like California where you have earthquake insurance, or in Florida where you can have flood insurance on one property and 2 houses away because it was built newer and on a higher elevation, your flood insurance is a third of the price? Like, you need to know your local market to know those costs. But the 3 main things that help you determine your yield is going to be price. How much are you actually paying for it? Rates. What are the interest rates? How are they impacting what your payment is going to be? And rents. So learning your area average rents in the market that you look is very important. And some people will use Rentometer, or I used to call the housing authority, and say, how much would you pay for a 3-bedroom in this area? Because they were pretty spot on for area average rents, maybe a little low. But Rentometer and the housing authority use historical data. What happened in the last year? And Rentometer switched to a 3-month model, and they're still 20 to 30% low in my area. Like, they're saying these houses will rent for $1,700 to $1,800, and the area average rents on where I actually find apartments.com, Craigslist, or Facebook Marketplace are $2,400, $2,500. So 17, 18, 24, 25 reality. So Rentometer is not good currently. Housing authority is really far behind. So to know area average rents, literally go to the sources in your area where most people rent. And some places that might be Zillow or Redfin, for where people are posting rentals. In my area, mostly it's on apartments.com, Craigslist, and Facebook Marketplace to find out what currently rents are going to be. Compare that to run the numbers. You want to find out what your yield is. The 1% rule is flawed and outdated and made total sense in 2010 when there was a whole bunch of deals to filter down to the ones that made the most sense. We're not in that market now. Even as we're swinging to a buyer's market, our inventory is not enough to where you need to filter down that much. And the 1% rule doesn't take into effect insurance cost differences, if you have an HOA or not. Property taxes, it could be totally different. So the 1% rule has never worked. And none of my deals have come close to hitting the 1% rule, but all of them have done 10% yield or better. Most of them average over 20% now. So to get the yield, and this is the Cliff Notes version at 5:34. So 1 hour and 34 minutes into the video. Annual profit divided by cost to acquire. That gets you your yield. Annual profit is your rents minus principal, interest, taxes, insurance, and setting aside for repairs, maintenance, and vacancy, and property management if you have a property manager. What's left is profit each month. Times that by 12 gets you annual profit. Cost to acquire is a combination of a few things. Down payment, which is what most people use, but it actually includes closing costs and make ready, so immediate repairs. Add those together, that's your cost to acquire. Your annual profit divided by cost to acquire will generally get you a percentage. It might be a negative, meaning you're going to lose money. It might be infinite. If you were to buy it with a 0 down VA loan and it needed no work, and they wrapped closing costs into the loan, no out of pocket. So there's a lot of ways to look at getting your yield, but you study your market to figure out what an average yield is. And it usually takes 2 to 3 months to figure out, okay, I've looked at enough deals to know that in my area, an average duplex will yield 5 or 6%. And is to hunt for 8%. It's the best deals in your area. My area averages 6 to 8, so I hunt for 10s. That doesn't mean a 10% is better than an 8% in someone else's market, because you're looking for the best deal in your local market. So lumberjack landlord for the last year has purchased deal after deal after deal where he's getting over a 20% return. That's amazing, right? But that means average in his area was a bit less than that. And he had some specific strategies that he talks about on how he got that yield. So that was the best for his area. Best for my area that I've been able to find, 10%. Again, I don't do rehabs. I want to buy with tenants in place. I have the binder strategy, which gets tenants to request the rent increase. So that helps, makes it a lot easier to find deals on the MLS without, special financing or being very creative. I work full time. I run a nonprofit. I'm a single parent with 3 kids who are older now, which would make you think it would take less time to be a parent. But oh my God. Yeah, it's not true. So I need to be able to invest and keep it easy. It is easy to invest because I have systems in place. I'm using traditional lending. I'm finding my deals on the MLS. I'm able to calculate my yield. I'm able to look at a deal, and within a few minutes, when you first start doing this, it might take you 20, 30 minutes to figure out if a deal is even worth looking at, because that's all the yield does. It tells you to take a deeper look or to pass. It doesn't tell you to buy the deal, because then you need to look at, is it in the area that I want, close enough to enough economic drivers, far enough away from my other properties, one of my criteria? Is it the property style that I like that helps limit tenant turnover? I like side-by-side units because you don't have tenants living above or below another, so you don't have noise complaints, or one plumbing issue doesn't impact 2 tenants. Is there at least 2 bedrooms and a garage for each unit? Because that means more space, which equals more stuff, so less likely to move, which limits tenant turnover. Is there washer dryer hookups in the units? Because tenants using shared laundry or a laundromat are just waiting for a place to open that doesn't make them do that. Is it pet friendly? I like to allow pets because people don't like to relocate their animals. And even if the human moves, that's still a relocation for the animal. So it helps limit tenant turnover. The reason I know that this is effective, and I can say this with confidence, is because I've been investing for over 10 years. I have 16 units. If you take my first tenant out before I learned any of this and started running it like a business, I've had 2 tenant turnovers. Until next week, I'll have 3. And then next month, I'll have 4, because one tenant inherited a house, one tenant passed away, one tenant just bought a house and is moving out now, and the tenant is moving out of the area. So 16 units over 10 years of investing, 4 tenant turnovers, because I invest with tenant turnover as a part of my strategy. My goal is to keep that number as small as possible. So everything I just said might be different in your area. Single family single bedroom might be a better because you're next to a college, or you do traveling nurses or something where they have their own living space. And that might be the better strategy. So find out in your area what is working best. I hope that helped. I hope that was what you're looking for. Austin, howdy. Been watching your talks for a year. I'm a teacher coach in Texas. Awesome. I'm 27 and about to get married. Me and the future wife have been looking at house hacking. Thoughts if this is realistic? I think it's very realistic. It's the only reason I'm financially free. I only had one income and I was able to do it. Especially if you're in an area where it's expensive. The more expensive the area you live in, the more important house hacking becomes. Like Millennial Mike, he invests in Seattle as a house hacker. Makes sense. He's saving $2,400 a month on rent, right, for himself. He invested in this in St. Gary, Indiana, where the average rents are a fraction of that. Wouldn't make so much sense to house hack in Gary, Indiana, because you're not reducing a big amount, but you're reducing a big amount in Seattle. So if your area is expensive, house hacking is more important. Lower down payment, better interest rates, reducing or eliminating your housing costs, like all of these things that come from house hacking that make it more important. I don't know if I want to say you asked kind of the wrong question. Is this realistic? I think, are you willing to have neighbors in a house with an ADU where you just literally live on the same property, no different than having neighbors, or where your garages touch, so you have a shared non-living wall? That's how a duplex, fenced off yards and everything. Are you willing to do that for a year or 2 or 3 times? To repeat the process, to make the next 50 years of your life work completely optional? That's how important house hacking's been to me. So not only realistic, highly recommended. I think you could do it. I think you can nail it. That's powerful motivation. Literally being able to do whatever job you want, not worry about the pay, because all of your living expenses are covered. North Colorado Dawn, howdy. Ultimate bargains. Add the cost into the overall offer and then get the monies back in contingencies. Did I miss something? Oh, there you go. So I answered that question. Good. The Leviathan. Thank you, Don, for that. That was a good answer. The Leviathan. The issue I'm having in my market with FHA isn't so much the sellers, but the FHA flagged my application because the property was smaller, cheaper than my existing one, and within 100 miles of my first. Right. Check with different lenders and consider conventional. For a duplex, you might be able to find a lender that'll do 5% down conventional. That whole within so many miles and smaller, you're not pursuing going to a single family or a larger single family, all that goes away. That's what I would try. Johnny Cashflow. Howdy. What's up, real estate freaks? Alec. I have to have said this before, Johnny. Your name, Johnny Cashflow Ramirez reminds me of the movie Highlander, where Sean Connery's character's name was Juan Sanchez Villalobos Ramirez III or something like that. I think I say that every time I see your name. Alec, howdy. Do you think the states will be slowing down as I live in Charlotte, North Carolina, and people are still moving here? If you get a chance, watch the first 10 or 20 minutes of this video. I really talked about not only the slowdown, well, a lot of people are saying slowdown. I'm calling housing crash. I'm literally saying we're having a crash in transactions, and here's what's different. Buyers have pulled back because interest rates went up and either took them out of the ability to buy because they qualify for less. It's taken yield away from investors. Sellers are in kind of panic mode because they've been watching prices go up and up for 2 years, thinking when it gets to this stupid, silly price, I'm just going to sell because it makes more sense, right? Well, they might have waited 1 or 2 months too long and interest rates changed. So now instead of property selling in 2 or 3 hours, this is the metric you watch in your area. Days on market. In my area, I'm in Washington State, pretty far away from you. Properties would go pending within 2 or 3 hours. Offers would come in, waiving contingencies, over asking, people offering to name their kids after the seller, all of these things to try to get the seller's attention. Over asking offers have come down. Redfin has talked about how many, not the percentage of the decrease, but percentages of 20 to 30% of the number of rentals doing a price decrease. So it might have been $1,000. It might have been. So we're starting to see more of that. So I would watch your area to see how many days on market. That's the one metric that will make sellers reduce their price. And I do think interest rates went up because the Fed announced they were going to raise rates. Then they raised rates, and then they raised rates again. For the last 2 weeks, rates have come down, and I'll explain that on Thursday. But they've talked about rates going up 4 or 5 more times this year, meaning less buyers. I don't know that we're going to see an overall nationwide crash. And the biggest nationwide crash we've seen in the last 50 years was 2009, where the overall price reduction of properties was 8.9%. So when people talk about a housing crash, they're talking about 20%, which does happen in local markets. Sacramento, California, where Michael Zuber lives in 2009, 75%. That can happen. But as an overall, the market crashed 8.9. That's the largest decrease we've seen in 50 years. So an overall crash of 20% or more, highly unlikely. But we don't need a crash. You need to find that one seller who has to sell. Not the person who is like, oh, prices are getting so silly, I'm going to sell because that's a lot of money, right? The person who is moving away, getting a divorce, death in the family, the rare move-up buyer now because a lot of people are price locked in low interest rates. That needs to sell and has their property sit on the market for days. That's the person who's going to take the offer that makes sense to you. Offer this morning on a property that's been on the MLS for more than 10 days. The offer that the seller has it at didn't make sense. My offer is less. I'm currently the only offer on the property. I should know in a day or two what they think they're going to do. If they accept my offer where it is, I still have an inspection contingency in place. I have an appraisal contingency in place. I have the inspection period. I will then go decide if I want this property. Buyers going forward are going to have the power. Sellers had the power for the last 2 years. Fear of missing out was on the buyer side. We were going over asking, waive contingencies. Speed was your friend. You had to get an offer in hours, if not sooner. Now, the strength that you have as a buyer is patience. You will win if you're patient. And I even had to remind myself of that this morning when I was making that offer. Like I found a great deal, and I was like, oh, this is actually a great deal at my number. Been on the market more than 10 days, so I'm making my offer less than theirs. But I was in a rush. I was like, email, text, call my agent to get their offer set up. My lender was super quick. Like 10 minutes, I had my letter of pre-qualification, offer submitted now. But I didn't need to. Right now, our strength comes from patience. The longer it sits on the market, the less power the seller feels like they have. You might find some sellers who are like, this is a great price. I'll sell if I get it. And if they don't, it just sits on the market because it doesn't cost to be there, or they pull it off. Other people are going to be like, yeah, I'm not getting my price. I need to sell. I have an offer in hand, and strength to close might be what really matters. You might get your offer accepted. And my chat moved. There we go. Gus, howdy. Gus Frink. Howdy, Dion. I'm thinking now would be the good time to sell my primary house. I've been working my way to try to get into developing. The cash from the house would be a huge help in starting. Thoughts? My home has around $700,000 in principal balance, and the market valuation is around $1.4 million. The home is my primary residence. I am married with 2 kids as well, running on my own general contracting business. So if you sell, where do you move? It's your primary. Do you move into a house hack? Because even with your kids, you can move into a house with an ADU. There are duplexes with 4 bedrooms each side, 2 bedrooms each side. There's big ones. I've got a triplex where the house is 1,700 square feet, and then each side of the duplex is a 2-bedroom. So there are ways to house hack where there are big enough houses for families. I call it a triplex. It's a house and a duplex. One of them is an ADU. I don't know which one. So the question before sell, refinance, HELOC, pull cash out, refinance, or anything like that is, how will I deploy the funds? If you have a way to deploy the funds that's going to generate income, how will your business handle the recession that's coming? Less transactions are happening, less builds are happening. I think I showed at the beginning this image. Where was it? These are the number of builds in the last. Each line represents a decade. So we had decades where we were building. The red line represents the last 10 years. That's how many builds we've been doing. Since 2008, building has kind of fallen off a cliff. What will a recession do to that? Because if you put your primary house and the equity in it at risk for a business, you might be better off with a small business loan. Maybe instead of selling, what about a home equity line of credit? So you only use the amount of money that you need. Remember that impacts your debt to income ratio. 1% of the value that you could borrow is factored into your debt to income ratio because you that amount, and that might be the payment. So there's a couple of risks there with that. Your confidence level in your ability to grow your business, to put your primary house at risk when you could do a small business loan and through the LLC where the business is at risk, separate that from your housing. Just like right now, I wouldn't recommend people selling their primary to buy investment properties, because right now, if you have a primary that has 30-year fixed rate debt, and in the last 2 years, you could have refinanced to 2.5 or 3% interest on an owner occupied house, anything that you buy going forward right now, your interest rate is going to be 5 or 6%. So you're going to pay way more interest. Prices have gone up. So yes, you have equity, but where you're going to move to is, even if it's a downgrade in house, it's probably going to cost you the same or more. That is a hard decision to make without all of the details. I would probably find somebody who runs the type of business you're trying to grow, who's done it, and pick their brain on what they think is happening in the current market and what they think the next year is going to go like. That's what I would do if I was trying to grow a business to invest with. Having a lot of equity isn't a bad thing, but being safe with it is. Land acquisition, 500,000 budget, estimate building cost, 350 for a 1,500 square foot, 3-bed, 2-bath. House permits, architect planning costs, 50,000. Developing raw land. Right. So it depends on your municipality and how fast they are with permitting too, because you're going to have the burn rate for all the months or year or more that it takes to get the property done. I have friends who started building in 2020 and have been messing with supply chain issues, city, municipality changing their minds on things. Um, yeah, cost of materials, all of those things to factor. I think it's still hard to put your primary at risk on something like that. The Leviathan. I will definitely keep you posted on the results of this second purchase, be it this property or another one. I can't thank you enough for the content. Thank you. Thank you. I appreciate it too. Amancio. Aloha. Howdy. The 808 is Hawaii's area code. Nice. How can I use my VA benefits to buy multiple properties? Or how can I maximize that benefit to the most efficient way? What is your ability to save money? I have not used my VA loan yet because I like to have an equity position. I've my first duplex, I saved 5% down. Everyone since then has been 20 or 25% because I like to save equity. So one of the benefits to the VA is you can do zero down, but it starts you out 100% leveraged, which might not be the best position to start in. It's also like FHA. It's a little harder to get sellers to accept VA or FHA because there's some hoops to jump through. The property basically has to be live-in ready. You can have more than one VA loan at once, so you can buy multiple properties. You do have a intend to occupy for 1 year. If you get duty station changes or if you change jobs and have to relocate, there are reasons why you could do less than that, just like with FHA. They took loan limits away in 2020, so there isn't a loan limit amount. So it's going to be what you can qualify to borrow will be your loan limit amount, and then you'll have a certain amount that you can borrow. So you have to find out from your benefits what's left, whether you could buy 2 duplexes in the next 2 years or a duplex, a triplex, and a duplex based on what you have left for your, what do they call it? Your benefits allowance. There's another word for it. On what you can do for it. I know that you can have more than one, and also you can also look at other things like, even though you have FHA available, sometimes conventional loan might look better because all VA loan available. All VA really does is makes you not pay mortgage insurance. That's really the only benefit. So if you can handle mortgage insurance, or if you can save enough down, you don't have to have mortgage insurance. It is a good benefit to use, and it can go up to 4 units. So a lot of people think VA loan means I can buy a house. Well, you can buy a duplex, triplex, fourplex, or house with an ADU. So you can buy a small multifamily. You still have the 12-month intend to occupy requirement. So you have to intend to live. You're going to commit fraud. They're going to move into the property for at least a year to live there. So you can buy a fourplex, live in 1 unit, rent out the other 3, and then in a year move out and buy another one. As you house hack, you reduce or eliminate your housing costs so that you can start saving up, so that after 1 or 2 properties, you don't need to use the VA loan again, and you can actually start putting 20 or 25% down to not have mortgage insurance. Get a loan accepted easier and have a better equity position. So the struggle with investing in real estate is that the first 5 years suck. Everything feels like it takes forever. You go 1 or 2 years sometimes where it doesn't feel like you're taking any action, and then you buy a property. And you got to take care of it, manage it, learn the systems, get all your systems in place. And then 2 years later, you buy a property, or a year later, you buy a property. We do hear about things like Cody Davis and Christian, where they, within a year or 2, they go up to 80 units. Like, it's totally possible to do that. But it's very easy to reproduce 10 years to financial freedom or less, buying a rental property every 2 years. Because around the 4 to 6 year mark, the income snowball kicks in. You have more cash flowing assets producing that cash flow for you to save and invest, as long as you avoid life creep. And then the next 4 years, like, it becomes a struggle to figure out how to put the work and where to put it. Like, you have to find the deals. It's just those first 5 years that are going to be the hardest. Adam, howdy. You want to house hack, but have a family, so you can't. Your family is your reason to house hack, not the barrier. They are the reason to house hack. They're why you need to. I'll invest eventually, waiting for the market to drop 50%, which has never happened in our lifetime. The largest drop ever in any 1 year was 8.9% for the market. There are some local markets, like when Detroit and all the car people move away. So if you're waiting for the housing crash to happen at 50%, you will never buy a property. So find a different investing strategy, one that you can invest with dollar cost averaging, small amounts over years. Use the Trinity study, invest in stocks or crypto or something. If you're waiting for a crash, it's never going to happen at 50%. And thank you for coming to the channel. Because then I feel like I'm going to attack you. And I'm not. I want to help you. I want to motivate you to do this because you can house hack. How many millions of families live in an apartment complex, right? Millions. Is your family that different than them? And you're not even living in an apartment, you're living in a duplex or a house with an ADU. Literally fenced off 2 houses that don't touch. Like, have you lived your entire life with no neighbors ever? It's no different than that, except you get to pick the neighbor and live for free or make money where you live. Like, that's the reason to house hack. If you can save, and if you need a 50% drop in real estate, you're never going to save enough to invest, because I've never seen a drop of more than 8.9% in my life. And I'm like half a century old. There are markets that dropped, but not the market. And there are absolutely zero, none, like null tax benefits for having an LLC at all. The IRS in 1996 actually determined all single member LLCs are considered, and that means you or you and your spouse, that's a single member LLC, are disregarded entities. It has absolutely no impact on your taxes. It can make them worse if you make an S corp and then pay yourself out of it, because now you got to pay the employer and employee side of taxes. So you can really screw your taxes up by having your structure done wrong. I probably butchered on how that works. I just know that it's more confusing than it needs to be. There are no tax benefits to having an LLC. There is no asset protection to having an LLC unless you have partners. In the 2 counties that I invest, the court systems use the IRS as precedents to disregard all single member LLCs. It's not even mentioned in court. You get sued, all of your assets are all of your assets. Each one of your LLCs is just your assets. So the reason I get so animated when an LLC thing comes up is because your life will be better if you get on the property ladder. Here's a statistic that will help. At retirement age, so 60, there was a study done. The average net worth in the United States of a homeowner, not an investor, not people with rentals, just a homeowner, is $221,000. The average net worth of a person who's been renting at retirement age at 60, $6,000. It's like 6,800, something like that. So 221 versus 6,000 just by owning a house. So my net worth changed from 2020 to 2021 by 600,000 just because I own 7 properties. So it doesn't even take like hundreds of units to become super wealthy. I'm not super wealthy, but I'm financially free. Just because I own properties and appreciation happened. I'm really glad you came to the channel. Hopefully I can get you on the property ladder. You don't need to house hack. It's just the easiest way to reach financial freedom. You do need to get on the property ladder, and waiting for a crash is a mistake, because we're in a crash right now. We're having a transaction crash where we're seeing, like, we had over 6 million transactions last year. This year, we're on track to make a little over 4 million if things continue the way they are, and rates are going up. So it might even become worse in transactions. So in the beginning of this video, I talked about the things you need to be doing. And part of that is taking action. Learn your market, find out what area average yield is, watch days on market. Because 2 years ago, it was speed was your friend for the last 2 years, not 2 years ago, but for the last 2 years. Now, patience is your friend. When you see a property that's been on the market for 10, 15, 20 days on the MLS, you could start making under asking price offers. Here's why you don't need a 50% housing crash. If you want to buy a property and you have to put down 20 or 25% and it costs $500,000, you need to save $100,000, $150,000 because of closing costs, immediate repairs, having reserves, like all that kind of stuff. If you buy a $500,000 house with an FHA loan, or your first house with a 3% down conventional loan, and a house with an ADU qualifies for single family lending, even though it has 2 units and you get to rent out the other, your down payment is $15,000, not $150,000, not $120,000, $15,000 to get into a house with an ADU where the other person pays almost all of your mortgage. So now you've reduced or eliminated your housing costs. You're gaining appreciation on that property. Every month there's principal pay down. And because of real estate, this is an overshare. And I haven't even drank much tonight. Last year, profit with 16 rental units. And I give very specific numbers. Please don't sue me, bro. Profit, so after paying principal, interest, taxes, insurance, after paying for all repairs and maintenance that actually happened, after setting aside for future repairs and maintenance that haven't happened yet, I made, so for my job, I had a 6-figure income because I run a CDL school. My income was not that when I started investing. It was $17 an hour as a single parent with 3 kids, who were my reason for house hacking, not my barrier. So I had a six-figure income with my job, and I wrote a check to pay for taxes. I made $128,000 in profit on rentals. Cash flow after all of those expenses that I had, 128,000. Zero in taxes. I carried forward an $8,900 paper loss because of depreciation and write-offs to where it looks like I lost money, but I profited 128,000. No matter what you're making at your job, the tax benefits are not as good in a retirement account, in a stock portfolio, in almost any other asset class that you can invest in except for real estate. It's almost like there are 400 or 500 people in Congress who make the laws who own rental properties, because every law they come out with benefits rental property owners, because we have a tax incentive program, not a tax penalty program. The more you make, it's graduated. The more you make, the more you'll be taxed. But in investing, their goal is to make investors pay nothing in taxes, because that encourages people to make housing, to grow businesses, to do all the things we need to have an actual growing GDP, right? So if you're here, please watch some of the videos. I'm telling you, maybe you don't have to house hack, but getting your real estate doesn't take a 50% crash for you to get into the game. There are all kinds of ways to get into real estate investing where you don't have to have hundreds of thousands. House hacking is one. Seller financing deals is another. Cody Davis and Christian. That's Cody and Christian Multifamily Strategy, I think, is the name of the YouTube channel. In less than 2 years, over 80 units, seller financed. None of their money in the deals. And some of them, there's a ton of ways to do this. Hopefully you didn't feel attacked. I'm trying to share. Getting on the property ladder will help you. And an LLC is a barrier you don't need, because there's no benefit for what you were looking for there. Ultimate bargains, subject to and wraparounds are great. Just be sure that the existing debt makes sense. Right, you're going to calculate your yield based on that debt. Gus, forgot to mention you're locked in with it. You've got a low fixed rate. So it's FHA though. So refinancing out of that, you're stuck with mortgage insurance and until rates come down significantly again, if they do. North Colorado Dawn. My grandson is going to college this fall, and I am considering buying a fourplex with him as an owner occupant to get the low down and let the other 3 units paid off while he's in school, getting him on the property ladder through the sneaky way, the legal sneaky way. I have several friends who have done that. They buy a house, they put their kid in it. They buy a house, they put their sister in it. They do something in the family, owner occupied. Their name is on the mortgage. And you could fix that later if you need to. But I think that's a great idea. Fire must burn. Howdy. Factual name. How do you feel about new construction homes and house hacking? So new construction is more of a really long play, because it's generally not going to cash flow for 5 to 10 years. The cost of building right now, especially if you're acquiring the land and building, and all of the timeline, the burn rate to get it done, the time it takes to get it done. So there are some people who can make new builds work. Todd Baldwin, who buys 5, 6, or 7 bedroom places with as many bedrooms as possible and rents by the room, is running a very successful business. So it's a YouTube channel called Todd Baldwin. He's in Seattle, so high cost of living area. I don't know if he has ones built or if he buys new build or fairly new, but it's working for him. But renting by the room is a very different model than what I do. I do long-term leases. Each unit rented out. I haven't done traveling nurses. I haven't done Airbnb. I haven't done all these creative ways to make more money, because I'm working full-time. I run a nonprofit, still raising 3 kids, and I like to have a life. So I like 16 rental units where I talk to the tenants maybe twice a year, each one, maybe twice, and maybe some of them I haven't talked to in over a year. That works for me. Cash flow made work optional, financially free, money to reinvest. There are more ways to make money, but I think if you get into new builds, for house hacking, especially if it's by the room, I would binge watch everything Todd Baldwin puts out and try to duplicate his process if that's what I was going to do. Laura, Dan Hunter, I keep my accounts very similar to Dion. One personal checking account, one checking account for the duplex, property management, cent rents. There, one online savings account for reserves, emergency, and personal to invest. Perfect. I love it, Laura. That's great. And thank you for the comment. And my chat moved down, and I saw there was a bunch of porn down there. So if you need porn, it's in the comments. Where was I at? I think I lost my spot. Oh, that is okay. If you ever ask a question and I miss it because my chat moves around, please ask it again. I won't be offended. I won't. And sometimes I just miss them because it's me. My goal is to get through every question and answer everything. Suyash, thank you. Thank you. Laura, I appreciate the comments tonight, Laura. That's great. And after I get a discount if I pay taxes earlier, plus by me making the payment, I know it is done. You do know it is done. That is a good thing. My lender would have paid any fees if it was paid late because it is escrowed. Yeah. Mandio, howdy. Should I buy now looking to rent, but its mortgage prices, also interest rates are crazy high? Yikes. So you're in a really good position to buy right now. The fear of missing out for the last 2 years belonged to the buyer. We had to do over asking, waive contingencies, all these crazy things to try, speak to your friend. Well, right now, rates went up. Some sellers were hoping to get these crazy prices as they kept going up, but now interest rates made it to where people can't. Either some people don't qualify for the amount or they can't find the yield. Like you said, prices and rates are so high, but there's three factors: price, rates, rents. Can you find the yield? And where you have now, the strength that you have now comes from patience. We have sellers who just think, if I can get a stupid, silly price for my property, I'll sell it, right? So you're not going to buy that one because they've got this really high price. And it's going to sit on the market long enough to where they go either, wow, I'm not going to sell it, so I'm going to keep it, I'm going to take it off the MLS, or it just sits on the MLS for a long time. But you're going to have other sellers who have to sell. Some change in the family, move, work, divorce, childbirth, someone passed away, whatever the thing is going on in their life that we will never probably know, they have to sell. They put it on at that price that made sense because that's what everyone else was tracking. Then rates changed. And now we have the one metric that can ever make a property price come down. And it's not comps. It's not what their agent says. It's days on market. Every day that a property sits on market that's longer than what the seller was expecting gives you negotiating power. So your job right now as an investor is to do a few things. One, stay on top of interest rates. Talk with your lenders every week to find out where they're at. And it could change even faster than that. Second, know your area average rents. Rents have skyrocketed in the last 2 years. So I would be checking on apartments.com, Craigslist, Facebook Marketplace, or if there's some format in your area where where people get their rents from, use that. Know what rents are because it's price, rates, rents, right? So now you know to what price is going to make sense for you to get the yield you're looking for. So you need to study your market, what area average yield is, and then look for better than that. It is always a good day to buy a great deal. And right now, I'm more excited about the next 6 months than I've been for the last 4 years on finding great deals. Because the longer properties sit on the MLS when sellers weren't expecting them to, the more likely they are to take a price as long as you look good to close, like you're a solid borrower, solid closer, they're more likely to take a lower offer, which could be the one that makes sense for you on your yield. For 2 years, a lot of content creators have been saying there's a housing crash coming. So don't take action. Sit back and wait for the crash. I've been saying for 2 years there's no crash coming, and that sitting on the sidelines and not taking action is a mistake. That's the biggest mistake we can make right now, is not take action. Even if the action is just studying rents, rates, prices, watching your market, looking at days on market, whatever the action is that you're taking, doesn't have to be making offers or closing on deals. It could be learning your market. For 2 years, I've been saying take action. So if 2 years ago somebody listened to somebody saying there was a crash coming and they didn't take any action, they've missed out on 2 years of massive rent increases, like up over 40% in my area from 2 years ago, without having to do rehabs. Just literally tenants asking for their rents to go up 40% year over year, 20% for 2 years. Appreciation that can go away if prices come down, principal pay down, like all the benefits for the last 2 years. I've been saying there isn't a crash coming, don't wait for it. What I'm saying now today is we're in a crash. We're not waiting for a crash. You are in a crash in transactions, which means fear of missing out shifted to the sellers. And now you have negotiating power. And it might be price, but it could also be seller paying closing costs, us adding inspection contingencies back instead of waiving them, us adding appraisal contingencies instead of people waiving those, like things where it's more balanced and not quite a buyer's market where we've got all the power, but we've got more power than we had 6 months ago. Great time to buy. Suyash, how do I decide BW a house or a condo as my first investment property. I live in SOU, Seattle. Thanks for your answer earlier. Thank you. And thank you for the questions. I appreciate them. 2 hours. You drink. One of the criteria for me buying investment properties, whether I'm going to house hack or not, no HOA. Most condos that I know of belong to an HOA. So that pretty much, I don't search for condos or townhomes or anything like that. And it's not the HOA fee that's a problem. I have a video on my channel called No HOAs. Or actually, it's HOA or no HOA. And then it's 10 minutes of me ranting about no HOA. The fee, you factor it in. It's an expense, like your mortgage insurance or your homeowner's insurance or whatever your expense is. You could say that's what that costs, right? But you're going to have random assessments. This happened to a property that the lumberjack landlord was selling, where pretty much every tenant had to come up with 70 grand out of nowhere. I think that was the number. It was significant. Most I've heard here in my state is 5 to 20,000 out of nowhere because they want to replace the motion gate. That worked fine, but someone likes the new design. Someone on the board wanted to do that. So a random assessment can kill 1 or 2 or 3 years of cash flow. You could buy in an HOA where they require 10% or less of the units to be rentals. This happened to a friend. Bought a rental with a tenant in place. A few years later, the tenant moves out. But at that point in time, the HOA was over the 10% of how many rentals they could have. So his only options, according to their CC&Rs, was owner occupy or sell. Because you can't place another tenant because they were over there. Someone else messed up and let too many tenants in. And this is just personal experience from the one property I've had that's been in an HOA. HOA boards are generally made up of people who have nothing better to do than mess with their neighbors. And if you're in the good old boys club, or girls club or whatever you want to call it, of everybody who knows each other, you can get away with murder. Literally dumpsters in your yard visible from the street. Paint your fence whatever color you want. But if you're not, which I wasn't, none of that can happen on your property, and everything you do results in a fine. I would not own in an HOA if it came with free tacos. So that takes the condos off. If you're looking at buying and you're by the college, you might look at doing what Todd Baldwin does and buy a house with as many bedrooms but as many bathrooms as possible so you can rent by the room. Because the more equivalency you have in bathroom and bedroom count, the more money you're going to get. And you can do traveling nurses, you can do college students, you could do whatever. That's an option for Seattle. Be very aware of the rules in Seattle. There's a reason why my criteria says these 2 counties, specifically 39 counties in the state, but these are the 2 I invest in. Nothing in King County because the leadership is insane. This state has an RCW, a revised code of Washington, that makes it illegal to have rent control. It says it is not legal to impose rent control. So Seattle came out with their own version. If you do a rent increase and the tenant doesn't like it, you have to give 6 months notice. And if the tenant doesn't like it, you have to pay to relocate them. Look, that's rent control. There's other crazy laws too. So know where you're investing first. And there are some people like Beth Traverso who invests in King County and does it successfully and is just probably way more successful than I am. So I'm not saying it can't happen. I'm saying there are reasons why I don't invest there. But I don't know if I would buy a house if you could buy a small multifamily, a duplex or a triplex or a fourplex, and owner occupy one of the units yourself and still rent out the rooms in your unit. You can house hack a couple of different ways if it's possible. You can really reduce, eliminate, or profit. I'm being paid $2,500 a month to live in the unit of the fourplex I'm in. Like, that doesn't suck. That's just one property. $2,500 in profit. I should buy some more properties. So should you. Daniel Pitchler, howdy. Thanks for the comment, Dan. You are now 79 days from retiring, I think, or 70 something days, because in 2018, you started investing in my area. You invest in houses with ADUs in a creative property. I'd like to do a deal deep dive on you that has 5 units on it. 4 years, made work completely optional and get to retire before regular retirement age. Good job. Andrew, howdy. The vodka isn't Lower, I replaced it with water. Oh, no, it doesn't. Yeah. That would not surprise me, but it wouldn't surprise me when you were 15, but you're not 15 anymore. Just tastes like water. I know what you're talking about. Peter, so that's my son talking about my Alien Vodka, who sponsors today's video, which is not a real sponsor, but they are what makes me able to talk, not well, but my voice work for 3 hours. Thank you for that, Andrew. Peter, howdy. Do you have an agreement document you use with a hack tenant? I use a regular lease. I just spell out in the lease, this is the room areas, this is the common areas, this is my areas that you don't have access to, whether they have access to the garage or the shed for storage, how much of it they can use. I mean, just spell it all out. It's an agreement between two people. So yes, I have a rental agreement that I use for my units, and I have a rental agreement that looks exactly like that for my shared space tenants, that spells out in more detail how that works. Check your local area on what requirements are, because each state is different. So agreements like that aren't like, I wouldn't take a Colorado agreement and use it in Maine. I wouldn't take a King County agreement and use it in Pierce or Thurston counties. Like, the counties that you live in can even be different. One of the best things to do is to contact an attorney. What I do is, and I got this from my brother, so it's way smarter than me. He has an attorney that you have on retainer for evictions. In case you ever have one, you've already given them like the $1,500 or whatever to just kind of keep them on retainer. But he asked his attorney, what verbiage would you want as an attorney in the area that I invest in my lease that would make your job easier during an eviction? And then that attorney for your area in your county, for the court system that they work in, might give you a paragraph that you put in your lease that makes it a lot easier for you to be an effective landlord. So hope that helps. Daniel Pitchler. I am the mentor. Well, it took us 4 years, and it's not because I was trying to get rid of you. We are sad to see you go. I'm happy for you, but sad to see you go. And look at all the porn. When you get porn chat in your thing, it means you finally made it, right? Laura, Dion, please add the link for the motion detector 2. My tenants are asking you for one. So the motion sensor lights. Okay. So when I do the comment, just send myself a message. When I do the pin a comment for locks and lights, will do. Thanks. So what we're talking about there is, earlier I talked about what kind of locks I use in my rentals. I use slag coated locks. I'm going to put a comment down below, pin it with the locks that I use, and why. I'll put a little description. When I first acquire a property, I like to change the coated locks because my properties are all in Class C areas. They're not super fancy. They're not a war zone. But tenants like not having keys. It's kind of a perk in a Class C area that they're not used to. So I put coated locks on the outside. I also replaced the exterior porch lights, front and back, with motion sensor LED lights. Uses less electricity. Tenant still has a switch. It's brighter, so it's safer. The tenants see that I'm making improvements, and they know I'm going to take care of the property. So about 2 months later, when I use the binder strategy to get the tenant to request a rent increase, hopefully you're on my channel, you know what that's about. If not, let me know. But the tenants request a bigger rent increase when they know that I'm going to take care of the place. I've actually had tenants binder strategy me before I did them because they saw that I was fixing it. I moved into the fourplex. Tenants came over because I'd done the fixes, right? And they said, hey, we see you're fixing the place up. We don't want to get kicked out. We're on a month-to-month lease. They asked, if we raise our rent $155, would you please sign a 1-year lease with us? The binder strategy usually gets $300 to $400 increase generally. So this was the smallest increase I've ever done, but I was like, hey, totally fair. So I was binder strategied in reverse. Danielle, may I send you an email and ask more detailed questions? I would hope that people that have any questions that they don't want to share publicly feel like they can always reach out to me via email. Absolutely. Julius. Howdy. Hello again. My question is about your tenant base. I'm in Indy and we don't really have a military base to pull from. What other demographics do you suggest? So my area, I do have a large military base. So I go 1/3 military, 1/3 Section 8, 1/3 working or retired. So that a prolonged government shutdown, pandemic, or stock market crash wouldn't really impact me. If I was in an area that didn't have a base, I might look, what is there? Is there a college? So I wouldn't have more than 1/3 college students of my portfolio, if possible. If there's an airport, I might be kind of close to the airport. If there's a hospital, I wouldn't do more than 1/3 traveling nurses, because that program can change at any point in time. You don't want to have your entire portfolio impacted by some kind of policy change that you don't have control of. So you have college students, you have anything associated with travel, you have traveling nurses, so hospitals. You do have when you pick the size of your property, in certain areas, if it's more retirement based, single bedroom places might actually have lower turnover than a 2-bedroom, because 2 and 3 bedrooms get families which have kids and grow. Single bedrooms attract retired couples who are trying to downsize to live off their retirement now, and they're going to be there until they're not there, like literally not there anymore. So know your area like that. So you might diversify looking for different property types instead of different tenant bases. I just use those 3 because in my area, I have, it's pretty easy to control. And yes, if you're watching my channel, it would be illegal to advertise saying, I only want retired people, I only want college students, I only want military, I only want Section 8. But if you want college students and you advertise at the campus, who are you going to get? If I want military and I advertise on base, who am I going to get? If you want retired people and you figure out where the community gatherings are for, and I mean, this is going to sound totally ageist, but like the bingo hall, or, in my area, it would be the D&D group session gaming areas. Go put it up there. So whatever age bracket you're looking for will have a place that they are advertised there. If you want traveling nurses, you're literally going to use Furnished Finder, and you might get other things than traveling nurses, but still people who want more than a month but less than a year for rentals, which usually gets that increased cost or increased rent. I hope that helps. William Kraft, can you talk about assumable mortgages and how to pitch people on them, letting you do that for a better investment rate? So I talked about that a little bit earlier in the video. The challenge with that is the lender has to be on board. And if the person has a really low currently fixed interest rate, some lenders might not want that because they want the refinance. Rarely. So the lender has to be on board. One of the really good tactics that Matt, the lumberjack landlord, uses is finding out what matters to the seller. And if you find out that they are either underwater on their mortgage, where they owe more than it's worth, or they're just trying to get out of it and not trying to make any money, you might find out, well, what do you need? $5,000, $10,000, $15,000 to walk away so I can take over your mortgage? I think the lumberjack landlord and Michael Zuber might be the best place to ask those questions, because I haven't done assumable. I've tried to give mine away, like when I was trying to get rid of my house, and I would have let anybody just have it, basically, if they could take over the mortgage. I was underwater, so it didn't really work. And then the one time I found that it worked, it fell apart at the end. So luckily, I was stuck with a house that ended up being one of my best investments. Yeah, that's not one I've done, so I'm not an expert on. But I believe Matt and Mike have done a bunch of those, or they know more about them. And their live streams, Michael Zuber does a live stream Saturday mornings at 8 o'clock on YouTube, 9 o'clock for his private Facebook group. And then Lumberjack Landlord is on Sunday mornings at 11:30 Eastern, 8:30 Pacific time. And they're like me. They answer the questions that come in. Thank you for that, William. Austin, howdy. What is the best way to calculate how much house someone can buy when looking at a duplex hack? Also, my goal would be to cash flow into paying off the duplex, then buying single family and rent the duplex. First question, why would you ever want to pay off a mortgage? I see it now. If interest rates get up to 10%, it might make more sense to pay off the mortgage than to invest in another asset. So yeah, that actually makes more sense now because our interest rates are getting there. So if we're above 6, 7, 8%, it might make sense to pay off debt. I'm never paying off my mortgages early, the ones that I already have, because they're all are below 4% except for one. That one that's a 4.8, I'm either going to refinance if rates ever go down, or it might be the one I pay off, but it doesn't even make sense to do because Most of my investments, I'm getting a 10% or better yield. So paying off to get that 4.8% doesn't make as much sense. The best way to figure out, so when I run the numbers on a house hack, there's a video on my channel called House Hack Cash Flow. It tells you how to run the yield on a house hack. And it's almost clickbait, because how you run the numbers on a house hack is you remove the house hack from the equation. Run the numbers on the duplex as if it's the year after you've moved out and both units are rented. Because you're not trying to figure out how much you're going to save while you're living there. You're trying to figure out, once I'm done a house hacking and I move out, is this investment worth pursuing? So with the units rented and your expenses, and you're setting aside for repairs, maintenance, and vacancy, or property management if you have it, what would the yield be? And one other thing to remove the house hack from it is, if you use a zero down VA loan, it's very easy to look like you have a great yield, because if you make $1 a year, that's a massive return on $0. That's an infinite return. But is it worth taking the risk to self-manage a rental property and tenants or property manager for $1? So I take out the low down payment and I factor it as either I did 20 or 25% down on the property. So take the house hack out. If you purchase the property with a down payment of 25%, and it was the year after you moved out, this is what the profit would be. Cost to acquire, annual profit. Divide the annual profit by cost to acquire, figure out what the yield is. Is that better than the area average for where you're at? That's how I would determine whether a house hack was worth pursuing or not. So it's kind of clickbaity, because I said, here's how you run the numbers on a house hack, but I actually told you how I run the numbers on a house hack, which I've only done twice. I purchased a duplex. So I had a single family, I purchased a duplex as my first real investment property. And then several years later, I purchased a fourplex, which is where I'm at now. I might house hack again. I think in a year I'm going to use my VA loan, because I haven't used it yet. A couple of reasons why. But when I do, it'll be another fourplex that I house hack again. Being paid to live where you are is addicting. Yeah. Scott. Howdy. Thanks. Austin, thank you so much for this. Quality content over the quantity. Thank you. G. Glover. Howdy. Can you do 5% down on multifamily jumbo loan? I'm in California, home prices over 800,000, has to be a jumbo loan. Lenders are not all made the same. Lenders that'll do all kinds of things, but you're going to have to shop around lenders and compare what you can do. And sometimes the local credit union can be more creative than something like a big bank. So yes. And did you say small multifamily or duplex? So multifamily, triplex or fourplex, sometimes no. Like the more units, they get a little more requiring higher, they start to require higher down payments. But for a duplex, I know that it's possible to find 5% down, sometimes regular conventional loans. But if it has to be jumbo, remember, most places raised the amount for FHA in November of last year. So make sure you check with a current lender on what those caps are in your county, because it's different county to county. You could, and sometimes what you can do, I had a friend do this with an FHA. The loan limit for the county was a certain amount, and the property was priced more. So instead of 3.5% down, they purchased it by doing 8% down. Still FHA, but it covered that gap to bring the price to where they needed it to match. And it was literally like October last year. And then in November, the rates changed to where the FHA would have worked normal at 3.5% down. So things change often. Find out what's going on currently. Michael, howdy. I will just be moving out of my parents' house, and I will not be having a steady income under my belt because I haven't worked for the past year. How do you suggest I qualify for a loan? So you have a couple of options. First, good job thinking, how do I get property, not how do I find a rental, right? Hopefully you save reserves. Lenders are going to want you to have several months worth of mortgage payments in reserve. You're going to need, so down payment, reserves, money for closing costs, and immediate repairs. So like there is going to be an expense of getting into property, whether you qualify for the mortgage or not. For reserves, lenders will often look at 50% of a retirement account as a reserve. You don't have to tap it or take it out. You just have to prove that it's in there. So if you have $10,000 in a retirement account, you have a $5,000 reserve that the lenders will recognize. You have options like pursuing seller financing. There is a channel called Cody and Christian Multifamily Strategy. That's what they do. They have over 80 units in less than 2 years by finding sellers with 6 or 10 unit places that they sell on seller financing. So no mortgage problems at all. You also have non-QM loans where they don't look at you. Your credit score is going to matter. They're still going to look at your credit score. So hopefully you've been working on that with the goal of getting to 740 or higher. You can do this in the 600s, but 740 or higher gets you the best rates and terms. But they're going to look at the property. So if you go to buy a triplex, so normally asset-based lending won't do owner-occupied. So they won't use your income or your ability to save your rent there. So they're going to look at the property if all 3 units were rented out. Would the income from that rent cover the mortgage? So asset-based lending, non-QM loans. There's another term, DSCR, debt service CR. Wow, I have no idea what that means. But I have a video on my channel where 2 guys who actually worked for a company, Convoy Home Loans, explain what a DSCR loan is. And they probably use the term in the video of what CR stands for. So you have other options. Non-qualifying loans where they're looking at the property instead of you. Cosigner. Will your parents co-sign for you? Because if they're not real estate investors, maybe they don't care about only having 10 mortgages in their name, and they co-sign with you. They can co-sign with you and use your FHA loan. So their debt to income, their work history, their salary, everything that they can use for that, to talk with lenders to see what your options are, talk with your family to see what your options are. Most of that still comes down to your starting position. Have you learned to save? Because that's the first step in investing. And even at 10 years, the 11 years of investing now, it's a part of investing still. And saving is multiple steps. Most people think about reducing or eliminating expenses. So cutting out Netflix and not eating out and those kind of things. But you can only save 100% of your income. There's no limit to what you can make. Side hustle, overtime, change companies to get a raise. All of the ways that you can think of increasing income and then reduce those expenses, save and invest the difference. That's where that down payment, closing costs, immediate repairs are going to come from. And with DSCR loans and asset-based lending, the down payment is usually larger than the 3, 5, or 3.5% that you can get. You can do a conventional loan if it's the first loan that you've ever owned, but that will consider your work history. They might consider a co-signer on that loan, as if you're the owner-occupant, at 3% down conventional, but check with a lender because they already own a house probably, and I don't know if that disqualifies it or not. But that's a question to ask the lender. And that would be how I suggest qualifying for a loan. Ultimate bargains, Michael Channing, 2 cents worth. Learn creative financing and then get seller financing. Perfect. Hendrik, howdy. That's a table. Ultimate bargains, motivated or distressed sellers, they are the key to wealth. I totally agree. Monica, howdy. Can you give your numbers of deals that we are looking at so you can help us understand what we need to look for? So I'm looking at yield. There's 3 things to consider: price, rates, rent. So you need to be on top of what area average rents are. You're looking at the price and the rates to figure out what your payment is going to be, what your cost to acquire is, that closing costs, down payment, reserves that you have to have setting aside. That's not a cost to acquire. So down payment, closing costs, and money for immediate repairs. You will also need reserves, but that's the cost to acquire. Once you know the area average rents and you know what your mortgage in payment would be, and you have to factor setting aside for repairs, maintenance, and vacancy. So I set aside 10% for repairs and maintenance, 5% for vacancy. So when I'm calculating the numbers, I take out the principal, interest, taxes, and insurance, and 15% of gross rents, like the total amount of rents, not the profit, the gross. That gets set aside. What's left is profit. So if the mortgage is $1,000 and the rent is $1,500, I'm going to set aside 15% of $1,500. I think I did the math really hard for no reason whatsoever. So $150 from the 1,000 and $75 from the 500. So $225 is getting aside for repairs, maintenance, and vacancy. If you're going to have a property manager, you need to factor that in too. I self-manage, and I'm setting aside the 1,000 for the mortgage. So $1,225 is set aside. I'm profiting $275. Times that by 12. Hey Siri, what is $275 times 12.
$275 times 12 is $3,300.
So, because I'm not math the lumberjack landlord and can't do that crap in my head, that's why I have the phone. That was probably already saying the number or typing it. So $3,300 in profit in a year with that metric of my mortgage is $1,000. So that meant if I want a 10% return, I don't want to invest. It shouldn't cost me down payment, closing costs, and immediate repairs more than $33,000 to acquire that property, because that would be a 10% return. Those are really simple, basic numbers. There's a video on my channel called Cash Flow, How I Run the Numbers, that explains one of the properties I purchased, asking price, down payment, rents, like here's how I got my yield, here's why I bought the property. Specifically, like the numbers, it's like 298,000 for that property, like how I broke it down. What I just did now is just super basic round numbers. Math is step one. You're looking for the right yield. You want to make sure you're going to make the amount of money that you need to make the deal worth pursuing, right? But then there's all the other things. Is it in the footprint that you want, which is an area that you know, and you know where the good areas are and the bad neighborhoods to avoid? Is it close to several economic drivers? So you're not pulling tenants from one source. Like if there was only a base and nothing else around there, the base can close. If you're in an area where all the manufacturers are car manufacturers, what if they all go overseas? Because it would never happen. But if that did happen for 50 years, you still wouldn't recover in that city. But are there several economic drivers, like a base, a port, a college, a hospital, a beach, an attraction, like a national park or something, where you're going to have sources of tenants from more than one source? So 2 or 3 different things can change and you're still going to have tenants. Then it's the physical aspects of the property. Does the property have things that will help you limit tenant turnover? For me, it's side-by-side units, washer dryer hookups in the units, 2 or more bedrooms and a garage, so there's more space, pet-friendly yards, like all the things that I know help limit tenant turnover. Math, area. You should know the area because you're searching in a footprint. So I guess that would come first. And then physical aspects of the property. I actually had one more that you don't have to. A lot of people like their rentals close together because they're easier to manage. I like my rentals at least 10 miles apart. All of my rentals are 10 miles apart except for 2 that are 7. Because that way you don't have 2 or 3 properties pulling from the same tenant sources. So in my area, if the port closes down, I lose a tenant or 2. If the base closes down, I lose 2 or 3 tenants. If something big happens like that where 2 or 3 things go, I still have other tenants, and I can handle 50% of my rent's not being paid, and I'm still not paying any of the mortgages out of my pocket. So I'm more conservative because I'm planning on a crash, which we're in. I'm planning for a stock market crash, which we're in. I'm planning for a prolonged government shutdown or a pandemic, which we've been in for 2 years, and we still haven't seen the rents drop. And for the last 10 years, I've never had a late or missing rent payment. So even during the pandemic. But I sleep like a baby knowing that I've planned my portfolio around that. Tom, howdy. Made it back. I know you had a comment before we opened the thing today. I appreciate that. David, howdy. Good afternoon. I am stressed shopping for residential real estate in Los Angeles and commercial in the Northwest. Have you thought about looking a little bit further north into the edge of Kern County? Bakersfield, Rosemont, maybe Mojave. It's a bit far out there. But my brother invests in Rosemont. It's great. It's right on the edge of LA County. So you get the King County rules, the King County less anti-owner rules, and a better cost to rents ratio. Bit of a drive. So it depends on how far into LA you are. But draw a concentric circle around that. What is the other way? San Bernardino? What's south of LA? I mean, not quite down to San Diego, but there's something down there. How far out would you have to go before you found something that's a little more owner friendly and get the price to rent ratio that's going to help you get the yield you're looking for? But I've said it a few times in this video, in case you haven't been here for much of this, David. What you have right now, the strongest thing you have in negotiating with sellers is days on market. For the last 2 years, things would go pending in 2 or 3 hours. Now we're seeing properties sit 5, 10, 20 days on the market without offers. Now you could start making offers that make sense to your numbers and aren't the wish numbers that the seller was hoping for. And what your goal is to find the person who has to sell. If that seller was just listing it for sale because the price was silly and they loved it, they'll thought, well, that amount anybody should sell, and they're not getting it, they're just going to keep it and take it off the market. But if they have to sell and they don't have any other offers, and they've been on the market for a while, your offer that comes in lower starts to be more attractive. Hope that helps. Scott, I've always said no to pets, but maybe I need to rethink that. So it's a consideration. Kids do way more damage to properties. Like I had a kid rip a cabinet door off at a place, and the handyman went and fixed it. It's like $100. I've never had a pet do that. And people don't like to relocate their pets. It's part of the retention program that I've got. That taking a cat or a dog from one area to another, even if the human moves with the pet, is a pet relocation. And I've got some tenants that, they've got their little dog, and that, like, that's their world. They, in some cases, can't move because other owners in the area don't allow pets. So I literally have better rent control for myself, not the term rent control from government, but I mean, I control the rents better with my tenants because I allow the pets, and very little turnover. Non-refundable pet fee. Don't call it a deposit. A deposit by definition is refundable. And then a monthly pet fee. And another thing that this does is completely removes the nervous stuff I would have to put up with the BS fake printed out thing, which one of our employees printed out the other day because they might be moving, form that you could just print off on the internet saying, this is an emotional support animal, so you have to let me live here. I don't have to think about that. They live there. Now, I have had a time where somebody showed up with an emotional support animal and they said, so you can't charge me the pet fees. And I was like, you're right. You got 4 dogs. Which one's the support animal? They didn't think through getting 4 things, so they're paying the pet fee. Tom, who gave the market permission to crash, and why didn't they tell my market? It is area specific, but what you have right now, Tom, is in all markets pretty much a crash in transactions. Less deals are happening. Sellers are getting the fear of missing out now, and you're going to see that day on market increase. So you don't need the market to crash. We don't need the whole market to crash. You don't even need your area to crash. You need to find a seller that has to sell who takes the price that makes sense to you. That's the crash. The one property, the next one, do 10 deals this year. It's just the next 10 times that'll take that offer that makes sense to your numbers. Larson, howdy. Yeah, and what do you think of DSCR loans? I just talked about those. Hopefully you were here for those. I'm going to cover it really quick. They're good if they're fixed rate debt. I'm looking at Convoy Home Mortgage, who has 30 and 40-year fixed rate debt. So I'm looking at DSCR loans for those. They go up to 8 units. So it's a way to get around the commercial loans for 5, 6, 7, and 8 unit places. It doesn't take your work history. So if you've changed fields or don't have an income, don't have much of an income, but you have the down payment, and they'll look at the property. So they're very useful. Just like everything else, though, I would shop a couple of lenders, compare them against each other to get the best rates and terms. So even though I'm looking at Convoy Home Mortgage, I might, when I get under contract, then go out and hit some other DSCR lenders and see what my options are. They're a great option when possible. If you don't have 10 loans in your name, 20 if you're married and do your loans in each of your names, I would get a conventional loan because it has the best rates, best down payments. It's 30-year fixed rate. But when it's not possible, because you just moved out of your parents' house, you change jobs, or completely change careers, not just switch jobs. Because if you work in the same industry, that still counts. But if you switch type of job completely, that makes your work history 2 years start over. So they're a good option when they are the only option. If you can get conventional, that's the way I would go. Michael, ultimate bargains. Definitely a good strategy, but can be hard to convince lenders to trust you as a new investor with no history in real estate and with such a short credit history. True. Travis, howdy. Got here late. Go rewatch. Awesome. What is your cash on cash return goal on a duplex investment? My goal is irrelevant to you. I'm going to share my goal. I'm not one of those people that goes, I can't share because of whatever reasons. I'm going to share. Study your market and figure out what the average is. If an average deal, and like you look at 20, 15 are going to lose money. They're just going to suck, right? But the 5 that kind of make money, what's their average? Would they get a 3% return and an 8% return? What would the yield be on that? You look for deals that are better than that average so that you're putting your money to its best use. In my area, look at 20, 15 suck, 5 will make money. The average was 6 to 8%, somewhere in there. So I hunt for 10s. My area average that I look for in a duplex in my area is 10%. All of my properties were between 10 and 12%, except for one. My triplex started at 17% year one. By year 3, across the board, they're all about 20% cash on cash return in 3 years. Rents go up, mortgages basically stay the same. The binder strategy has a huge impact in that first year. And it's kind of cheating because in 2020 and 2021, we've seen rents go up so much. I did the binder strategy again on existing tenants and had a 20 to 28% rent increase at tenants' request. It was a good time to own rentals. It would have been a bad time to watch crash videos in 2020 and sit on the sidelines and not buy rental properties. Austin, thank you so much for some fuel to light my spark. Okay, awesome. Thank you for taking it that way because I felt bad like it was an attack. I'm trying to help. As well as convincing my fiance that it isn't a pipe dream to buy financially grounded. No. My position sucked. 10 years or less to reach financial freedom. I think if your position doesn't suck, you can probably do it faster. But if your goal is 10 years, set the goal of 10 years. Anything faster, icing on the cake. To have a life no one else can. Totally worth it. David, I really think we need 10% mortgage rates. Total BS. It's not causing the crash that we need, but it's closer. North Colorado Dawn. 1.75 speed, and you talk as fast as Stephen Dow from Velocity Mortgage. Nice. Jessica, howdy. Wouldn't buy a house in this kind of market. Now, I am hunting right now. Is the best time to buy. I think this is the first time in the last 5 years it's actually going to be easier to recognize the motivated sellers because they're going to have days on market, and they might take that price that makes sense. Let's say rates go up to 10%, like David thinks we need. Okay, I agree. 10% would be great. We had 18 in the 80s, so we can have 10% now. And prices come down 20%. Be great, right? 20% decrease on the price of the property. You're going to pay more. You're just sending more money to the lender than to the seller. What's the point in that? And it's going to be a suckier return because the interest rate is up so high. Buying a great deal now. If prices go down, who cares? Prices could drop by 99% and I wouldn't care. Rents haven't dropped since 1914 when we started tracking the data, other than 2009 when it only dropped in Class A neighborhoods, and it dropped in Class A, which I don't invest in, so much that it made the whole market look like it came down. But the rents for C and B areas went up in 2009 because of all of those people that went through foreclosures becoming renters, increasing demand. I say this often, so if you don't want to buy right now, good call, because you don't want to, don't do something you're not comfortable with. I say often, it's always a good day to buy a great deal. It's just right now in this crash that we're in, which is a crash in transactions. Who cares how you want to quantify it, but it is a crash. It's the easiest time I've seen in 10 years of investing to recognize a motivated seller. It's going to be days on market. They're not getting offers. And when you make an offer, they'll accept it. You're going to make offers on people who had that wish list price and they don't sell and they don't even respond. Not a motivated seller. All it took to find is make the offer. So when you make an offer and they come back with a counter that's way better than their ask price, that's a motivated seller. Or they just accept your lower price offer. Yeah. People have been saying since 2013, I will not invest in this market. Prices are higher than 2008. It's unsustainable. There has to be a crash or a correction. I'm going to wait for the crash or correction, which in this instance is happening because of higher interest rates, which means you're paying more, even if the prices come down, which they haven't. They're coming down from the wish list price. They're not going down below where they were last year yet. They will, hopefully. Like everybody's fingers crossed. We all, as investors, want a crash in prices, but you don't need it. You need to find the one seller in your market, in your buy box, that's selling the asset you're looking for, who has to sell, and you're the offer that makes sense to them. Time in the market beats timing at the market. Ultimate bargains. Michael Channing, the only lender for creative financing is the property owner. For seller financing, that is creative lending, but there is private money, there is hard money, there is DSCR loans, there is the 50% loan from the lender, 40% seller carry from the owner, 10% you. So there's like all kinds of ways to be creative. But when we say seller financing, that's creative, and the control is the seller, no other lenders. True. David, Jessica Jackson, but people are buying. People have the cash money. Yeah, people are buying. I am. I made an offer this morning. Like, I got all excited. Found that deal. Great deal, great price. Over 10 days on the market. Their price didn't make sense. My price wasn't much different, but it wasn't low enough to make me have the better than 10% yield that I'm looking for. I got all excited and I made a mistake. And this is what I'm hoping that people understand. For the last 2 years, speed was your friend. You had hours to get an offer in because fear of missing out was on the buyer side. Prices or interest rates could go up faster than you can get your yield. So we wanted to get the offer and we wanted to buy the property. Well, fear of missing out is now shifted to the seller side. That's why we're getting those days on market where sellers aren't getting the prices they expected. So they're afraid they waited too long and interest rates went up too high. So some of them are just not going to sell. Some are locked into low interest rate loans where they can't sell because buying anything else is going to double or triple their interest rate. And the prices are higher. When my brain shuts off, I'm going to take a drink because that seems to help. I think I missed here. Vatsal, how do you reconnect with people you met previously? Also, how do you get people to take you seriously? So it's a finite number of people that you're going to interact in the real estate world. Try not to waste someone's time. If I have an agent set up an auto search, I give them feedback to refine it better. I don't have them take me to showings. I don't look at properties. I don't use their time. They're only going to set up the auto search, and then I'm going to contact them when I want them to make an offer. Don't make an offer that you won't follow through on unless you actually find something tangible. Like I've only backed out of one deal, and I feel justified because I got there at $50,000 underappraised $50,000. I found $50,000 of all the trusses rotted, worth of damage I would have had to repair. So I pulled out. So I spent on an inspection and I spent on an appraisal, and I'm happy because I saved money not buying a bad deal. When I make an offer, I like this morning, get excited. I found the deal. This makes sense. It's on the market long enough for an under asking price offer to make sense. Text. And so email, text, call my poor agent. That was the mistake. Patience is our virtue right now. It's our strength. The longer it's on the market, the more negotiating power we have. We, for 2 years, had to be quick. I still got quick. All kinds of inappropriate jokes just came to mind, so I have to wait for them to go away. So you want patience to give the seller time to realize they're not going to get the offer that they're expecting. I still wanted to react with speed when I decided, okay, I found the place. I want to make the offer. I get the letter from the lender. Like, follow through and they'll take you serious. If you're looking for a mentor to take you serious, get a baseline. Figure out what you want to do because you can't talk to people and just be a basic mentor. I can't mentor you on wholesaling, flipping, the Burr method, relationships, probably proper parenting. I don't know. But I can tell you about buy and hold investing, how to calculate the yield, how the binder strategy gets a tenant to request a rent increase. Like how I find my deals. I can do the things that I've done, right? So if you don't know if you want to Burr, flip, or wholesale, talking to me as a mentor would do you no good. If you're looking to be taken serious, figure out what you want to do. Get the baseline from the YouTube channels of investors who've done what you're looking to do to understand at least the terminology, the timeline, the struggles, the things that you need to do yourself, things you need to outsource. And then the mentor just shows up. That whole, when the student's ready, the teacher arrives, same thing. Reconnect with people you met previously. The Book of Faces is a good one. Email, if you can never connect with it. But my goal is to not connect with people I knew a while, because there's a big difference between knowing somebody a long time and knowing somebody a long time ago. If they were in my life a long time ago, but they're not in it now, there's probably a reason, and I'm okay with that. But if you're talking about how do you reconnect with an agent who might set up an auto search or something, yes, you need to be able to find them. Social media is very powerful. In real estate, the BiggerPockets forums is a good way to reconnect. Hope that helps. Ultimate bargains. Michael Channing, credit doesn't matter. Usually no down payment. Credit does with a DSCR loan. They're going to check your credit score, but not your income, not your work history. But credit doesn't matter with seller financing. I almost corrected you for no reason whatsoever. Yes, seller financing, your credit doesn't matter, your work doesn't matter. The down payment and figuring out what matters to the seller. How much of a down payment do they want? Do they want the money for a vacation? Because the goal with seller financing is often to avoid large capital gains hit, to continue monthly income, to not have to deal with the headaches of tenants, termites, and toilets. There's probably some other benefits to the seller that I'm missing that's in my letter that I sent. The benefit to you, credit doesn't matter, income doesn't matter, work history doesn't matter. Down payment needs to be flexible. Generally, you're going to need to have your down payment large enough to maybe cover, if they have a mortgage, cover what that mortgage is, and enough to cover agent fees. So if you're using an agent to make this deal, your agents are going to cost you at least 6%, usually 3% to each agent, buyer seller. So your down payment should have enough to cover 6% of the total sale to cover agent fees so that the seller doesn't have to write a check to lose an asset, because that's going to kill the deal most times. Good point. Jessica, if they wait a while, I think they will struck luck. They could, but if you wait a while, rates could go up more. Prices can continue to go up, because rates going up don't mean prices come down. That's a myth that people keep saying. Every time interest rates go up 1%, buying power goes down 10%. That's true. Buying power decreases by about 10%. But wages set prices. Inflation sets prices. It takes more dollars to acquire the same asset. Prices are going up for all kinds of reasons that had nothing to do with interest rates. We're seeing wish prices drop back down. Redfin has shown percentages of areas where that percent of people did drops. It doesn't say the percent they dropped, but it says this many people did a price reduction, which means they overshot their list value when they put it up. But we're going to see less deals happen. So you're right. Waiting could pay off. But people have been saying that since 2013, literally screaming it. Last 2 years especially. There's a pandemic, don't buy. Rents have gone up over 40% since 2020. 20% each year, over in my market. You'd miss out on that if you didn't buy then. And while appreciation can go down from the wish list, I gained over $600,000 in appreciation each year for 2 years straight. Time in the market beats timing the market. If you want to wait, I'm on board. I support it. But here's the caveat. Every day, know your area average rents. Watch the prices, watch days on market, and think, what would the return on this property be? Because who cares how much it costs? I wish my properties cost more, as long as the yield scaled with the price. So my goal now, and the offer that I made this morning, fourplex over $1 million. I'm hoping, like hunting, I wanted it to cost more than $1 million as long as the yield scaled with it. Because if I put $250,000 down on the property, I'm going to add $25,000 a year or more to my cash flow as long as I hit my yield. A lower priced property doesn't mean you're going to get a better deal. Price, rates, rents, and rents are skyrocketing. So if you're going to wait 6 months, great. But don't sit back and go, okay, I'm going to wait 6 months. So in 6 months, I'm going to start doing the work. Because in 6 months, you start doing the work. Now it's 2 or 3 months till you learn the market. You figure out where rents are. You even recognize what a good deal is, because prices coming down don't mean anything. If interest rates are now 10%, it's going to cost you more. But if you're doing the work every day, you will recognize in 6 months, when you're ready to take action, the amazing deal that you find. It's there today. It'll be there in a week. It was there 2 weeks ago. Somebody found it. Somebody invested successfully. So in 6 months, when you find that deal, you will only recognize it if you were doing the work every day. Maybe 3-4 days a week at a minimum. So you're tracking what's going on with the market, because it's 3 things: price, rates, rents. And if you're not on top of all 3 of those, literally that week, no one knows what a good deal is. But you're all right. Luck is a factor too. Try that. Howdy. Would you buy a multifamily that sold in 2018 and yielded 25% cash on cash return, but now is for sale again over 170,000 more, but it still yields 10%? Having a hard time thinking that makes sense. Absolutely, all day long. I don't care if it sold for $1 yesterday. If I can get my 10% yield, it's like when people say, I don't want to buy from a wholesaler because that guy's going to make $20,000. I could just find the deal and not pay the $20,000. Well, then go find the deal. The $20,000 was to find a deal that got you your yield. They earned it. That wholesaler deserves the money. I have not met the wholesaler that's done that yet, but that's how that works. So the big mistake that buyers do is they look and they go, well, I sold for this much this many years ago. Did they do a rehab? How much have rents changed in those 2 years? If they're up 40%, $170,000 increase, is that a 10 or 20 or 30% increase to the price of the property when rents have gone up 40%? If your goal is a 10% yield, I don't care if it sold for $1 yesterday. If it'll appraise, if the rents will justify my yield, if I will get my yield and I'm confident and I know area average rents, I know what my expenses are going to be, I know I'm setting aside for repairs, maintenance, and vacancy. Like I've done all of the work that it takes. It's in the area I invest. It's not in the bad part of town. It's in a safe area to go collect the rents. It's close enough to enough economic drivers. It has all the other things I'm looking for. If it's gone up $1 million since 2018, but it checks off all those boxes all day long, don't even consider it. Don't look at what it sold for because it doesn't mean anything. And then there's some more porn. Yay. Ultimate bargains. TriLab, the multifamily 5+ unit mortgage loan is probably maturing soon. They cannot refinance at a good interest rate. Hopefully I didn't miss something there. Martin, howdy. I live in Wyoming, need to get a rental lease and application PDF. Any suggestions? Thanks in advance. So you can check your state's website. They might have a landlord-tenant resource page. You can also get a BiggerPockets Pro membership and do like a month. They have leases for every single state. Download the PDF, you then own it, and you can use it going forward. They were made by attorneys for every state because they're very state specific. I wouldn't want to lease from somewhere else. Apartments.com and Zillow and those kind of things, they might have a template. One additional thing, in case you weren't here about 20 minutes ago, something I get from my brother is when you get a lease, you can add to it. So he contacted his attorney that he has on retainer in case he ever needs to do an eviction. And he asked his attorney in the counties that he invests, where he would do the eviction, he asked the attorney, what verbiage would you like in a lease that would make it easier for you to do your job if we ever had to do an eviction? Then the attorney gave him a paragraph that he then added to his lease. So even if you get your lease from BiggerPockets, maybe contact your attorney in your area in case you ever need one and say, what would make your job easier to have in a lease? They'll know what's legally allowed to be put in there and they'll know how to word it for their court system. So there you go. Tammy, howdy. Good morning, good afternoon, and good evening. Every time Zuber says that, I think of The Truman Show, which was Jim Carrey, a movie. When I said that to Michael Zuber, he thought I was talking about The Truman Show from like some news network from the 70s, I think. I don't think he watches a lot of movies. His nerd is no good here. Why would Michael Zuber have to apologize for flip-flopping? He was very clear in his previous videos that he's talking about national numbers. He also said that the crash in transactions creates opportunities for investors. Also, he said that each location is different, and so we need to do the work. So I am a little confused because I don't see anything wrong with his analysis. I am a fan of his show and bought 2 properties below list price by looking into days on market. That is freaking awesome. Congratulations. That's amazing. So if you watch that video, Mike didn't want to make the video. He didn't want to make a crash video because it can be looked at as clickbait. And several of the comments called him clickbaity. So I get it. I know why he doesn't want to do that. And for the last 6 months, for the last 2 years, everybody's been calling for a crash. As soon as the pandemic came, everyone's like, oh, it has to crash. Well, for 2 years now, we've been saying no crash coming. Don't wait for the crash or correction. We might see a slowdown eventually, but it's going to take interest rates going up for that to happen because there's no supply. There's tons of demand. Well, there's not enough supply for the tons of demand. So I've been saying other YouTube channels that are calling for a crash are using clickbait. They're scare tactics. They're telling people like, I believe it was Jessica, I think if I remember the name, because my memory sucks, who was saying, I'm going to wait 6 months because that's what they're saying to do. Don't take action now, which is the mistake. In any market, you should be looking for the great deal. If you don't find it, don't buy it. So then, yeah, you waited 6 months till you found the great deal. Great, you win, but you looked every day for those 6 months. So we've been saying those channels are stopping people from taking action. So for 2 years, we've been saying, here's the action you take. Speed. Consider over asking as long as it gets your yield. Higher earnest money. Like I would say don't waive contingencies, but other people were waiving contingencies. Mike said don't waive contingencies too. So we were saying take action. What we're saying now is there's a crash in transaction. It is factual that we are in a crash in transactions. But for the last 2 months, me, the lumberjack landlord, Michael Zuber, the three amigos have been saying, we're not in a housing crash price crash. We're in a housing crash transaction crash, fighting for no reason, clarifying what those two terms mean. And it was stopping people from watching our channel because people want to hear about a crash. You could see from the comments, everybody's saying, oh, you guys just want prices to go up because it makes you richer. Well, of course, we want them to go up to make us richer, but we want to buy them on sale just like everybody else. So we want the crash just as much as everybody else because we're buy and hold investors. Rents haven't gone down since 1914 when we started tracking the data. So we're not worried about that, but we still plan for it, right? We're hoping prices go down to buy the better deal. So we've been kind of attacking the channels that were using fear to get views. So when we made the crash video, if you watch the first part of it, he wasn't on board until I clarified. We're shooting ourselves in the foot by wanting to clarify the facts when in fact we can just say there is a housing crash and leave out the words in transactions and just say there wasn't a housing crash for 2 years. Here were the things that work: speed, higher earnest, whatever worked for you, right? Here's how our businesses have changed now. Here's what we're doing different. Days on market, like you said, you've got 2 properties. By watching days on market, that's the point. You're still taking action. You're still looking for the great deal. We're showing you, here's how we're doing it in this crash. Even that shift, if you look at the comments, and there's over 300 comments on there now, about a third say, I don't agree with you. I'm going to wait until the crash happens. Totally fine. Somebody here too. About a third were like, your data has been showing this. This is a crash in transactions. And we can now be patient because patience is how this is going to work. We're going to watch days on market. Great. That third, that's going to benefit the most. Then there's the third, attacking Mike like he knew they would, saying, you've been saying other places are wrong, and now you're saying that there's a crash. You need to admit that they were right. Well, they weren't right because they were saying don't take action. We said take action for 2 years. We're now saying take this action for the next 2 years. It's just different action with the same goal of acquiring the next great deal. So that's why Mike wanted to take the time and say, look, I'm sorry, I'm flip-flopping. I've been saying there's no crash. He was. We have been saying there's a crash in transactions and clarifying that. And look at how many people. We make a video, we get like 1,000 or 2,000 views. That video of, hey, there's a crash, had 11,000 views the last time I looked at it. And now, if I could find it, that video has 12,000 views in one day, where we usually get 1,000 or 2,000 views in a couple of weeks because it had crash in the title. But it's not clickbait because we actually said it's a crash in transaction. Here's the different things you do to invest successfully now. So he wants to apologize because some people just aren't tracking that we weren't. He called it flip-flopping. We're not flip-flopping. We're just stopping saying 2 words in transactions. During the current housing crash, here's what you do. Watch days on market. Look for the motivated seller. Make offers that make sense to you. Like that's a shift from what we were doing for the last 2 years. So I'm with you. Mike should not have apologized. I don't think he should. But Mike is very humble. And he's like, hey, I get it. This seems like I'm flip-flopping and I'm sorry. And then he gave 10 reasons in his video this morning before his daily update to explain why he's flip-flopping. Not just, oh, I've changed my mind. Literally, here's 10 reasons. And he spelled them all out. But you're right. I don't think he needs to. And congratulations on your 2 properties. That's awesome. And my chat moved. Jason. Oh, God, stupid spammer. I know. Is it the same ones? Can I block them all? Report. Pornography. There you go. That's the best one to report for, right? If I report all 3 of them, will it go away later? Oh, there was a child abuse one to report too. I should have done that. It's not factual though. If I report them once, maybe they'll just go away. And this will just be a second while I do this a couple more times. I'm hoping that stops them from spamming again. But they just it's just a bot, and they'll make 20 more accounts. Report and then block. Yep. Rob, sweet porn spam. Rashad, howdy. How do you shop landlord insurance? I did a live stream a couple of weeks ago called Homeowners Insurance Mistakes. One of the first mistakes people make is thinking landlord insurance is a thing. Insurance companies will call it landlord insurance and try to upsell you and charge you more, but that's not a thing. And they hate it when I say this. And they usually attack me in the comments, so come at me, bro. You have property insurance. The property is insured. My policies usually look like $300,000 slip, fall, or injury, and then full replacement value of the property, of the buildings. Your lender's going to require you cover the cost of the mortgage. But as an owner, I want to be made whole, not just have the insurance made whole or the lender made whole. So I do full replacement value. Property insurance. If you live there, it costs more because they insure your stuff, your personal items, computer, TV, clothes, whatever else you have there. Relocation if there's fire damage, whatever the insurance is covering for you. So I lived in a duplex. Insurance was $900 a month. My other duplexes, the insurance was $410 to $490, somewhere in there. It was $420 to $490. I move out of the duplex into the fourplex. So I'm now house hacking a fourplex. The day I move out of the duplex, I call my insurance company and I say, hey, I no longer live there. Insurance dropped to between, it's like $450 or so. So it drops right down to what it should be without you living there. So I look at insurance like lenders, like contractors. When I'm buying a property, I call my broker and say, this is the address, these are the things, and I go through all the steps to get a quote. I call 3 or 4 other insurance companies and I get a quote and I go with the best one. Brokers got the best sometimes. Sometimes Geico had the best ones, and now I'm all Stillwater insurance through Geico, able to beat everybody else. Good coverage, good company to work with. I had great luck with them. But I shop around just like I would if you were going to have a $5,000 deck project done. You're going to get 3 contractors, 3 quotes, figure out materials, labor, cost, at the full quote, which one's the best one to go with, look up their reputation. So I wouldn't go with the fly-by-night one that I've never heard of before, but I wouldn't want to go with something that costs. I've had quotes on my duplexes from $400 to $5,000 for exactly the same coverage with Stillwater insurance. So like State Farm or Farmers or one of those was like, yeah, $5,200. And it's with this, and it's the same as the coverage, same exact coverages as I was getting for Geico for $430 or $440. So shop insurance just like you would a contractor and go with the one that makes the most sense. Make sure you're comparing apples to apples. The coverage is the same. Once I got to 4 properties, I probably should have done it at 3, but once I got to 4 properties, I got an umbrella policy on me with the properties listed. So that's $2 million in coverage, which cost me, it's a little over $600 a year. It was $550 up until this year. It went up a little. But that's when I was suggest getting that. But I wouldn't call it landlord insurance. Renter's insurance is something the tenant gets for themselves, usually costs around $10 a month. But landlord insurance is a fee that they want to put on insurance that doesn't mean anything. It costs less to have tenants living there than it does if you live there. So homeowners insurance, you tell them it's a rental. You don't live there. Otherwise, they're going to charge you more to insure your stuff. And you don't insure the interior stuff because that's the tenant's problem. My leases require that tenants have renter's insurance. I don't check or care. But it's in the lease so that if they have a problem, that's their claim. That would have been their problem. I required it. Not my problem that you didn't get it. I don't care if you had it, but I'm not going to pay for your stuff. Your insurance would have paid. That's how I do that. Ultimate bargains. Those porn sites install malware. When you visit them, stay away. And how would you know that? Kidding. Jason. Wow, amazing stats. I'm completely floored how bad off people are financially in this country. Yeah. Just 70-something% who can't afford a $500 expense without going into debt. It blows me away. And how many people have an average of like $7,000 or $8,000 in consumer debt on credit cards? Whew. Ultimate bargains, ADU, accessory dwelling unit. In some areas on the paperwork, it's called an auxiliary dwelling unit. So I get confused, but they both mean the same thing. Con, howdy. I have been waiting on sidelines for a few months, looking forward to picking up my second investment, hopefully within the next 6 months. Awesome. Have faith. You're going to do it. Ultimate Warrior. Never own or loan in an HOA. Hitler's outrageous agonizers. Okay. No, ultimate bargain size. Jack. I'm over 50 years old. What is some guidance you can give me to become financially free by the time I'm 65 and retired? I don't feel like I have much time left. There is a video on my channel, and I'm going to report these while I'm talking. It's like one of my very first ones, reaching financial freedom in 10 years or less, starting with $89,000 in bad debt. And that comes from making a 10-year plan. So here's the tagline for my content. My goal is to teach the average individual that you can reach financial freedom and make work completely optional in 10 years or less, even if you're not starting from the best position. And that's the tagline. The first 5 years are going to suck. It's going to feel like it takes forever. Like my first thing, it was 2 years before I bought a duplex. Save up the down payment and get my debt to income ratio right to buy my first duplex. It was 2 years till I bought the next duplex. 4 years, bought 2 things. That sucks. That feels like this is going to never happen. It's never going to take place. Year and a half to get the next one. Starts to speed up. Cash flow increases. Mortgages stay the same. Rents go up. Hopefully you work overtime. You have a side hustle. So those first 5 years are the ones that suck. Once the income snowball comes in and kicks in and you start having income coming in from a few different asset sources and you avoid life creep, no new nicer car, no new boat, no more expensive vacation, live life the way you were, minimize those expenses when you can. I don't live too frugally. I have every streaming service there is. Once I hit the income snowball, I went to ridiculous cars, went from a Ford Raptor, Corvette, Tundra picked up, which was my favorite. Now F-250 jacked up diesel with literally the compensator written across the tailgate. But that didn't happen until the income snowball kicked in. I still house hack, so I'm living for free. So I suggest if you can find a way to do that, even if you have a family, house hacking in a house with an ADU, reduce or eliminate that housing expense. No shared living space, no shared living walls. Like your family hopefully is okay with that because within 10 years, so you're 50, over 50. So you want to retire by your 65. So if you're 55 to 60, that's 10 years. I think if your position is better than mine and you have a better debt to income ratio and you don't have to wait 2 years to buy the first one, you could probably do it in 8 years or 7. And by 65, have a retirement that anybody else would kill for. Here's the weird thing. The advice for you is to do that now. The advice for a 20-year-old is to do exactly the same thing. 10 years to make work optional and reach financial freedom, even if you're not starting from your best position. 20, 25, 40, doesn't matter when you start. 10 years is the plan. You might do it sooner, but I can basically spell out the math where somebody on minimum wage can make work optional in 10 years. Might even be easier than somebody with a higher income because a high income usually has higher living standards that they need to replace. And more porn. Sorry about that. I probably won't take the time to block all of them, but that is good times. Okay, so they should be going away, hopefully. Kelly, a video walkthrough with your rental would be very helpful. Perfect. I will be doing that. And Jimena, yes, please. Thanks for having anybody who can report them. That'd be great. Andres, howdy. Have you heard of Pace Morby Challenge in Tacoma, Washington? Is it the exercise one where you put on the 20-pound weight vest, you run 1, 2, or 3 miles, then 200 pull-ups, 200 push-ups, and then another run or something? Is that the one? I do enjoy working out. I enjoy doing ground defensive tactics with law enforcement agencies more than anything else. But I'm getting older, and I don't think you should run unless you're being chased. So we'll see. Pace Morby's, Ron LeGrand, and Chris Kastan have good YouTube channels. Yep, agreed. The emphasis on creative financing. Yep. Bill O'Connell, howdy. CJ, Howdy. 100 people on a live stream. Remember back when we were pushing 40? Finished installing some keypad locks and headed home. Awesome. Nice. Laura took a message back to make me lose sleep. Michelle, as usual, great content. Hi from Athens, Georgia. Howdy. Thank you. Mandy. Howdy. Are there any online property price estimates that are accurate, like Zillow, Trulia, etc.? No, not at all. The MLS with historical data can tell you what comps went for in the area. To me, I'm more worried about area average rents and rates so that I can use the price. I set the price where that property would make sense and get the yield that I need. If it's at or above asking price, I make the offer. If it's below asking price, I wait for days on market to happen before I make the offer. Yeah, I haven't seen an online property estimate that's even anywhere close to accurate. G. Glover, thank you. Good evening. What are we at now? We're at 3 hours and 21 minutes. Goal was 3 hours. Nailed it. So if you're on the East Coast and it's past 10 o'clock at night, I totally understand if it's time to bail. I can lower my voice to the radio smooth and put you to sleep. Ultimate Bargains, debt service coverage ratio. Thank you, because my brain doesn't remember that kind of stuff. Michelle, credit ratio. Thank you. Awesome. And more porn. I'll block all those later. I think those messages are for you, Dion. Probably. That's awesome. G-Knife. Howdy. Thank you. Jason. Good question. I'm interested in that as well. G-Knife. So from G-Knife 909, if you bought a duplex home with mortgage rate for owner occupied and then your circumstances change and you can't live in it and you have to rent it out, have you broken the law? Who enforces this? Mortgage police. That is a great question. And the answer is, ready for it? Write this down. Take a note. This is a very long answer. Nobody. Nobody cares. When you purchase a property with an owner-occupied loan, try not to think that the Gestapo is going to come and knock on your door and figure out if you live there and if you're living in a livable space and if you're on an RV on the way. None of that matters. It's a time delay device. When you acquire an owner-occupied loan product for a year, or whatever your lender requires, 10 months sometimes, you can't get another without mitigating circumstances. If you get, duty service change in the military, if your job changes and you have to move and you can articulate why, they don't care. The difference between owner-occupied and investment is down payment and interest rate. Because where you live, you're less likely to give up. Like we're more likely to lose a rental than we are to lose our house. So you're less risky to live there. So the lender gives you a better down payment and a better interest rate. They're just hoping for that year that you're not going to, cost them money. I've never heard of anybody I have heard of people saying, I want to refinance because of whatever reason, told their lender where they were living. And it's like, hey, that's not where you're living. And you have an owner occupied loan. Like you self-reported. Sure. Don't commit fraud. Don't get the loan with the intent of not living there. The requirement is not to live in the property. The requirement verbatim is intend to occupy the property. You must have actually, and I have a friend who bought a duplex, went through an eviction, kicks the other guy out because the guy was a jerk, mean, rude, he paid for a while, then he stopped paying, whatever the reason is, whatever the reason for the eviction was, right? Guy's big, guy's a prison guard, guy's like all kind of reasons why this guy is going to be a problem. So she doesn't move in. Who cares? If the lender calls her and she goes, yeah, I bought a duplex, but I had to evict a guy and he was big and scary and I don't want to live in a place where that guy knows where I live. What lender is going to have a problem with that? Have a story to why you don't move in, but you initially intended to move into the property. There's a reason why you didn't. They'll understand. But you're not going to get another owner-occupied loan for that 12 months unless you have some other mitigating circumstance which allows it. So that is a great question. Don't commit fraud, but it's a time delay device. Nobody cares where you live. Bill O'Connell. I know of a landlord who requires tenants to have insurance on property. That is a way of keeping people from making stupid use claims because they're going after them in the process. So I require it in my lease. So they can't come after me. They were required to have renter's insurance. So if they have a claim, that's their problem. Doesn't matter if they have it or not. And then Ryan took back a message to make me lose sleep. Laura, thank you for the comment again. Building an ADU or buying, with pricing coming down, not sure what will be more cost effective. That ADU guy has a lot of information and answers email. He is great. I'm in contact with the city. That's perfectly. You're doing everything right. Look at the city. How friendly are they are to it? Talk to contractors. How long do permits usually take? What is your burn rate for the build? What would the yield be? And then with that ADU guy, figure out what size of ADU is going to give you the best yield. Sometimes it's not the biggest ADU that gets you the best yield. And he's super helpful. He will actually answer your calls. Sam, and my chat moved. I'm probably going to go through the questions that we have in here now and then wrap up for the night. Let me see. Where is Sam? I lost my chat. Okay. Are dog bite incidents documented somewhere online? Do you rent to tenants with cats, and is there a way to minimize their damage through the lease or deposit or anything else? So I've never actually experienced pet damage, but I don't have carpet. Carpet is gross and nobody should have it. I do LVP in all rooms, kitchen, bathroom, bedrooms, doesn't matter. People can put down throw rugs if they want to. I've never had pets damage LVP. I don't know about dog bites being documented online. If your insurance requires certain breeds or certain weight restrictions, you can require, and tenants require their own insurance and then provide you with a copy, name you as a person on their insurance policy. I allow pets. I've never worried about it. I've never had issues. I've had more problems from kids than pets. I wish we could legally discriminate against kids because they could trash everything. We can't, so you don't. But you can do a pet, not a deposit. Well, you can do a deposit, but you have to give it back if there's no damage. What I do is a $250 non-refundable pet fee. If you call it a deposit, that makes it refundable. So that's a contradicting term. So a non-refundable pet fee and then a monthly pet fee. And the only way around that is they might provide you with this is a service animal or support animal, and you can't charge a fee for them. And the one time that's happened to me, the tenant had 3 other animals. They had 4 dogs total. And I was like, yeah, which one's the support one? Because the other ones you're paying for. And put everything in the lease. They're going to pay for damages, and you can increase the deposit to whatever you're comfortable with. You can deny pets, but you're probably going to have higher turnover because people with pets have a harder time finding places, so they're less likely to do turnover. And they're just going to show up with a fake BS printed out thing from the internet saying it's a support animal or the service animal, probably real training or whatever, but a support animal, you could just go and Google it and print it. And that, so I've never had to deal with that because I'm like, I don't care. You can have the pets. It's just going to be, here's your fee. Burhani? Oh, Burhan Group. Howdy. I appreciate the content. Single dad, truck driver, veteran, and real estate investor. Thanks for the information. Good. I'm hoping some of my information, you can use that because that's a very accurate match. Harrison. Sam, can I ask for a whole year rent up front if a tenant is moving from another state and check all my other boxes except for that they're not working yet, but they have the money? Sold house in California. I think you can ask for anything you want, depending on your area. Figure out what they're allowed to do. Make sure there's no local rules against it. I would ask property managers in that area what they think if you can't find it on Google. The problem is if the tenant moves out before the end of the year, you're going to have to do the refund because that's technically their money until the rent is due. So you'd have to put it into an account that earns interest because some areas require deposits or an interest-bearing accounts. Money that's the tenant's until the rent is due every month is actually theirs. So it's possible. I would look into options like a co-signer, larger deposit, before I would charge a whole year's rent. Because it's kind of a red flag when somebody reaches out and says, I would like to pay a whole year's rent. Is that okay? That usually means they have the money now. They don't think they're going to have the ability to maintain their spending, to have the money to pay every month. So if they can't do that in a year, you're probably going to be dealing with some kind of eviction problem. That's a kind of a unique situation. Daniel, hi. Say hi to my wife, Sarah. Howdy, Sarah. How are you? Amy Phaser, Army Phaser, Amy, Army Phaser, pew pew. It does need a 30K rehab though. Did I miss Army phase or something? I think I missed something. REI Stoners. Sorry, Army phase. REI Stoners. Howdy. Following your lender procedure, where does the agent fit in as to knowing how much you qualify for? So you're not required to tell your agent what you're qualified for. You're required to show proof that you can qualify for what you're making offers on. I usually just tell the agent, I say, look, once you've had rentals for 2 years, how much you can qualify for kind of goes out the window. Debt to income ratio doesn't matter. Your salaried amount doesn't matter. They'll start looking at the rental income of the properties you're buying. So it's so much easier to handle. Lenders will literally tell you, because this is what they've told me, after 2 years of having rental income on your tax returns, you can buy anything of any price that you have a down payment for. So that becomes the limiting factor. But when I could qualify for up to 300,000 or 400,000, I was searching for a little bit more, because eventually we're going to shift into a market like we're seeing now, where we have days on market and it becomes a buyer's market instead of a seller's market, where you can start making under asking offers. So if you can qualify for 400 and you're only looking at 400s, you're never going to see the 430 that a 380 offer made sense on, because it was on the market for 20 days or whatever in your market would have been long. But I would share it with the agent, because the agent and the lenders usually talk. And they're under no obligation. Like, they don't sign in an NDR, at all, NDA at all. This is DNR, so I need tattooed here, but there's no NDA in place. I think ethically they're not going to share anything with the agent, but a lot of the communications are going to be like most of mine. It's, here's my agent, here's my lender's emails, group email together. Here's what I want to make the offer. So as long as your agent knows you can qualify for what you're offering on, they'll see the attachment from your lender. Your limit you might not have to share. Michael Smith. Howdy. Question. Can you give an update on the trucking industry? Still need drivers, more regional needs? It's absolutely nuts. Everyone's hiring. Sign-on bonuses are up. Most are doing a 20% pay increase across the board. Our company just had to do that. So last week I talked about it. This week we've announced it. So we did like a 20% pay increase just to keep the staff we have, because everyone is hiring. The driver shortage is just as good as ever. That's my housing update. And as short as I will do it on this channel, because I need to make another channel that's about trucking, because 98% of the people here don't care, don't want to hear about it. Well, that's not, they don't care. It's just not what they're here for. And time is important. I want to make sure the time is most beneficial here. Local needs everywhere. Don't drive over the road. Don't drive regional. You'll make way less money. Schools will try to tell you that you can make more money going over the road, because they get paid twice. They get paid to train you, and then they get paid to place you with an over-the-road company where the job sucks and you're not paid very much. Get a local job. Daniel, how do you find sellers interested in seller financing? Make an offer for both. Here's my seller financing offer. Here's my offer with traditional lending. When you make an offer, you make both, because you need to, generally, you're going to want to find a seller who doesn't owe a lot of money. So I wouldn't look for properties that were built in the last 5, 10, or 15 years. They still have a mortgage and a lot left, usually. So that reduces your chances of finding a seller that has enough equity to do seller financing. But make an offer for both. Make the seller financing look more attractive. I'll do seller financing at 2% interest, but I'll do 100,000 over your asking. Price is still less for me, because the interest rate's way less than I'm going to get from a bank. That's not what I'm sharing, but I'm telling them I'd rather pay interest to you. You don't have to talk about balloon payments. You don't have to talk about interest rates of super amount. It doesn't have to be more, because most sellers have never heard of seller financing. And a lot of agents will tell you that seller financing is illegal, because it's people trying to cut them out, right? So if you literally tell your agent, make sure the other agent knows, my down payment includes enough for the agent fees to be covered. Here's my seller financing offer. Here's my conventional loan offer, so that they'll pitch both to the seller. That's what I would do. Make the deal, make the offer all the time. 2 different offers. REI Stoners, do you do walkthroughs while tenants are living in your units, or just leave them alone until they move out? If it's Section 8, I pretty much leave them alone, because the state will do walkthroughs and they'll let me know of any problems. I do have 2 properties that have HVACs, so I will use the excuse of switching out your HVAC filter once a year and then leaving 3 for them to do it, giving me an excuse to walk through. I generally don't care what the inside looks like. When they move out, the repairs needed to be done are going to be billed to them, whether it's out of their deposit or more than the deposit, whether I knew about it or not. So I've never really cared. I mean, there are some safety issues that you can do, but I've never had that concern either. You can generally tell by the way the property is being kept on the outside how the inside's going to be. So yes and no. Not for Section 8. The ones with HVAC, kind of. The other ones, if I ever go there, I'll usually have a handyman. If they go to do something, they know to tell me, "Hey, it looks like there's 19 families living here," or something like that. Or they've hung sheets to make new rooms because there's so many people, or whatever. Tell me little things like that. Why does that happen to my property? That did happen to one of mine because they had a family staying there when they were having a baby, which I don't care. I don't care how many people stay there. Where was I at? There we go. More porn. I'll go through and block all those later. Ultimate bargains. Zuber is clarifying, not flip-flopping. Absolutely. Chester Williams, be careful to add in transactions, though. No, I'm not adding in transactions. That's the thing we're changing. We're taking out in transactions. We're saying, in this housing crash, here's what we were doing and here's what we are doing. Because every time we say in transactions, it turns people off. People just want to hear about the crash. Fine, we're having a crash. Did you hear it? Didn't say it. It was there, though. And here's what we're doing different. Stupid porn people. Okay. Buddy 3. Howdy, buddies. How do you think the downturn in transactions will cause a decrease in housing prices? Concerned about an upcoming appraisal. The prices are going to come down from wish prices because days on market are now starting to pile up. And we didn't have that before. For 2 years, it was speed. If you didn't get in quick, you weren't getting your offer in. Now, the goal is to be patient and wait for those deals to come out. Comps are still a factor when you're looking at appraisals. So ask your agent to run comps for the area, And if it's an investment property, run comps on rentals, and you can provide information to appraisers if you do it, I don't want to say ethically, but politely, because if you're condescending, you can piss them off. But if you just go, hey, look, I'm buying this as an investment. Here's what the rents are of the areas around here that I'm going to be looking at. Same number of units. This is how I'm calculating my yield. You can help them do their job. If they're not receptive to it, don't push it. Because in some areas, you're not supposed to talk to the appraiser. But I have done that. I've gone and said, look, this is what the rents are at now. So yeah, it sucks. But here's what the rents are in the area for similar sized units. And it's like this much more. And the appraisal usually comes back at offer price. Usually. RAI Stoners. Now I need to rewatch your seller financing video a few more times. Awesome. T. Stella. Howdy. How do you decide on a respectful good amount to offer if a property has been on the market for a while? The longer it's on, the lower you can offer. What are comps going for? What were comps going for? What are rents justifying? There's really no limit to how low you can make the offer. You just have to think, if I was the seller and it came in at half my asking price, am I even going to bother answering that person? But if it comes in at 10 or 15% lower, and it's been on the market longer than normal. So if your area properties are on 20 days and then they sell, and it's on 22 days, probably not going to negotiate much. But in my area, they were on 2 or 3 days was the longest you would see before it was under contract. And now we're seeing over 10 days. Now a 10 or 20% decrease starts to make sense. So think if you were the seller, what would you consider how long it's been versus how much of a decrease justifies you thinking it was worth more than what it actually is? Good question. Army Phaser. We change the AC filters every few months. Yep, that's how we do our walkthroughs. And I do that too. Geo, howdy. I've paid off all my debts, only have 8 years left on my $870 mortgage for a 3-bedroom foreclosure I bought in 2010, sitting on $15K. I am so excited to find my first rental. Awesome. If you bought it in 2010, have you refinanced since then? Because if your interest rate's really low, I would really focus on saving for the investment I wouldn't pay any more extra towards the mortgage. I know that there's some people who are really debt averse, and I'm consumer debt averse. We shouldn't have credit cards. We shouldn't have personal loans. We shouldn't, if you have a car and you have a payment on it, there should be an asset paying for it if possible, right? Like, so I'm anti-debt too, but I'm not anti-mortgage debt. If you are if your interest rate is below 4 or 5%, and that's a debt I want to take as long as possible to pay off, because you're going to make more money off the rental than you would paying that off. But I think you're at the right time. Cool. And we're going to be wrapping up here in a few minutes. Chester, all I've done is report those bots for the last 10 minutes. I know that's why I stopped doing it. I'll just have to do it. I'm going to go back through my live chat and report each one. Hopefully they don't show up next time. Not sure I can ban it to where nobody can make a link, but they're doing creatively, putting spaces in. Keith, howdy. Do you ask the seller why they are selling? Never, not once, ever. Don't care, because it's going to be a made-up story and not all the details, and it won't tell you anything. Also asking how I can help you. What are your needs? Well, it's a YouTube channel. One of the best ways you can help me is to leave a comment, because let me tell you about how sad my days are sometimes. This is an app. This is the YouTube app, right? So if you go down here, you can look at your content. I can see how a video is doing. It ranks at 1 to 10, tells you how you're doing. But over here is this comment section. Do you see the comment section? Do you know how sad it is to wake up and go, I don't have anybody to talk to in my comment section? 10,000 subscribers, probably 300 videos now, and no comment. I refresh it and see if there's any on here. None. That's what you could do. I like comments. I like getting to respond. I love questions. I love the live stream. So there's a ton of comments here in the live stream. So those don't show up there. It's the comments on the videos, because that tells the YouTube algorithm that somebody likes the content. So it's more likely to share it with other people. So even if you watch a video from like 9 months ago and you go and go, well, how do you get multiple mortgages? And you watch that video, if you leave a comment, I appreciate it a lot. The biggest compliment and best thing you can do for any content creator that you know, and this is what we all hope for, and I don't say this enough, but let's say somebody says, should I have an LLC or not? Should I have a property manager or not? Should I invest in single family or multifamily? I have a video for those. If you're in the Facebook group or in BiggerPockets and somebody asks that, I am not allowed to link my video because I'm the creator, right? I can link Michael Zuber's video. I could link Lumberjack's video. So I do that for them sometimes, and find, Millennial Mike's video whenever it's somebody investing at a distance. Go, check this out. So if you see somebody ask a question and you've watched a video of mine and you post a link to my video as an answer to their question, that's the biggest compliment you can give to a content creator ever, because it's something we can't do for ourselves, but it helps somebody answer a question that we have the answer to. Thank you. North Colorado Dawn. Jack, I am going on 59 next January. It is never too late to start. I had to restart in 2016. I own 11 units and I'm financially chat moved. And am financially independent. Just go slow and steady. Totally agree. Christopher R. Howdy. So glad I got to watch live from Michigan. Awesome. Chester. The crazy part is single family rentals are the best inflation adjusted and risk adjusted asset class right now. So I agree, Chester, with one little twist. If you buy a duplex, triplex, or fourplex in a housing community or cul-de-sac where it's all small multifamily, yeah, single family are going to perform better. But my units go single family, triplex, single family, single family, single family. My units are appreciating with the air comps around it. So if you find small multifamily or house with an ADU in an area that is all single family and that area appreciates, you'll gain that appreciation with small multifamily almost exactly the same. North Colorado Dawn. Jimena, thank you for the idea. I don't know we would report that garbage. Murph Dog, howdy. Have you considered analyzing deals on your lives from different areas? I do want to. I need the 10-year-old to show up to teach me how, because I have the paid for Zoom to use Zoom to stream, because then I could share my screen. In YouTube Live, there's no way to share my screen. So I have to have a streaming service to do that. But I would like to analyze deals live and show people different areas. You'll go to a live, say, give me your area. We'll look at a deal. We'll look at properties. Absolutely. Chester, randomly speaking of voice, how's the narration for 15? I just finished chapters 11 and 12. I have to edit them, send them to Mike. So there's 3 more chapters of 15 Conversations with Real Estate Millionaires by Michael Zuber that I'm narrating. And then there's like 3 sections of, so it's like 6 more, and each one takes about 5 to 8 hours to do. They don't take that long to listen to. They probably take like 30 minutes to 45 minutes, but it's like 5 to 8 hours to edit it, to record it and edit it. So still working on it, getting there. Finding a place to record is so hard. I thought at work, so at my work, I've got this room where it's quiet, like you can go in there, totally have a conversation, very quiet. I've never realized until I was recording that building pops and creaks like an old log cabin in the middle of nowhere in a snowstorm. It's frustrating. And more porn. Army Phaser. I was 3 hours late as usual, but just picked up at half for up a 2-1 for 30,000. Awesome. Congratulations. Nice. And that's the one where you said, but it had needed a 30,000 rehab. Okay, so that's weird because those came long apart. Chester. Non-disclosure agreement, DNR, do not resuscitate. That's why I want the DNR tattooed right here. Harrison. Howdy. I'm a trucker. I'd love to hear more. So, right, I totally get it. So I need to make a channel on transportation, commercial driver schools, getting your CDL, current industry trends, that kind of stuff. This is not the channel for that. Because as much as I liked having a CDL and knowing I was always able to walk out and get a job anywhere, it was just the avenue to financial freedom, having income. So whatever the income is, whatever the job is, cop, nurse, driver, teacher, sell drugs, whatever, I don't care. Whatever your job is. Saving and investing the difference between income and expenses is how we reach financial freedom. Ryan. Howdy. And howdy, Harrison. I had my agent tell me that we couldn't make multiple offers on the same property, like the financing offer and the seller financing officer. Oh, you mean that agent you used to work with? Makes sense. Unless your area has some rule that I don't know about, but I make multiple offers on every deal, and I have now for about a year. Wish I was doing it before then, too. Jeremy, howdy. Haven't seen you in a while. Hi, Dion. 2 of 8 units up and running, and that we picked up in the last 2 months for Airbnb. Awesome. Now the fun part with hardwood restoration on an 1868 quad and a 1901 duplex. Wish us luck. I do. Sounds like fun, though. Send me some pictures. You have my contact info. It's awesome. Lane, howdy. Just found you today on BiggerPockets. I'm also a PO and a realtor. PO. So welcome to my channel. Thank you for finding me on BiggerPockets. As you watch my channel, you're going to realize that I believe I have great content and I put it in a teachable format where it's retainable. But I also have some memory issues, and an acronym seems to be one of the things that I don't keep. Because I'm thinking probation officer, because I was a cop for 8 years. But I'm not sure that's what you're saying. Lane, I'm wanting to know what you would advise on learning the numbers and how to analyze a property. Thanks. On my channel, there is a video called Cash Flow, How I Run the Numbers. That's how I literally run the math. I also have a short. It's the only short I made because I wanted people in a minute or less to be able to figure out how to calculate their yield. So if you go to my channel and you look at shorts, it's the only one that's there. It's how to run the numbers and calculate the yield. But that's not how I run the numbers. The longer video, Cash Flow, How I Run the Numbers, literally, here's the metric I use for figuring out what my cost to acquire is. Here's my metric I use to figuring out what my annual profit is. Here's the equation of annual profit divided by cost to acquire to get the yield. Yeah. T, thanks for the lives. Thank you. Jeremy, I'll be commenting and not on cam. Girls out. Nice. I'm going to be logging off here in a few minutes too because it's getting pretty late on the East Coast. Ryan, I love being able to share your valuable information on those pages. So glad to hear that it helps you out. Yeah, no, I appreciate it. Every time I see when somebody posts one of my videos, that's a cool compliment. North Colorado on Stillwater doesn't insure in Pueblo. Yeah, you got to find the one in your area that will. There'll be somebody similar. And then some years Stillwater doesn't offer umbrella, and then some years they do. So insurance is a tricky thing. Kind of like lending, changes all the time. See past the porn. Chester. Debt is misleading. The purpose of using debt is the real why. Arbitrage, get a higher cash on cash return than the interest percent of the mortgage. People that are afraid of having debt aren't afraid of debt. They don't trust the asset. If you invest in a rental property and you're confident in the rents and you're confident in the vacancy and you know that you can take a 50% rent decrease and still make your mortgage, debt doesn't seem so scary. So let's take a little quick example. Let's say you had a time travel device and you can go in the future. And in 1 year, Bitcoin was $1 million a coin. Something happened in the next year where legislation, and you just knew, you had a crystal ball, like you physically could see the future. In a year, Bitcoin was worth $1 million. Its peak was around 70. Now it's in the 40s or 50s or wherever it's crashed to currently. But you knew in 1 year it'd be worth $1 million a coin. How much debt would you generate to buy Bitcoin if you factually knew everyone that you buy at 40,000 is going to be worth $1 million in a year because you trust the asset, because you have that certainty? So that's what with real estate, since rents haven't decreased since 1914 when we started tracking the data, other than 2009 when it was just Class A properties that decreased enough to make an overall crash look like it happened in rentals, even though rentals in Class C and B areas went up every year. Some were flat, but it's never gone down. That's the confidence I have in the asset, which is why I'm able to have the debt on the asset. I don't have the confidence in stock, so I don't want to do margin. I don't have the confidence in crypto and all of the other things that we can use debt to generate income with, but I do have it with common sense. I don't want to be over leveraged. 70% is my maximum loan to value that I would go. I think I'm a little below 50% LTV right now. So I want to create some more debt because I want to gain more appreciation than what I invest. I want to see more principal pay down, like all of the benefits that come from that on an asset that I trust. I need to make a video about that. And I hope that I come out halfway as articulate as I just said it. Chester. Glad you mentioned that saving and investing is the path to financial freedom. Yep, saving won't make you rich. Laura, Dion, thanks so much for the RE therapy session. You are an amazing teacher. I greatly appreciate you sharing your knowledge. Thank you, Laura. I appreciate all the comments from you tonight. That was awesome. Lane, I'm a police officer. Oh, okay. I would have called it a Leo. Nice. Okay. Nice. Thanks for the info. Cool. I was law enforcement until 2008 when the recession hit and our department said there's no more crime anymore, so we don't need as many cops. And for the first year, because I really wanted to be a cop. I was a cop for 8 years. For the first year, I was like, I feel like I'll just drive or teach at this school for a little bit until law enforcement picks back up, and then I'll go back to a department. And my daughter changed my mind without even knowing that she did it. And I'll try to keep the emotion out of my voice, but it's one of the few times I cried, and I didn't cry in front of her. I went and did it in another room. But she came to me, and she was late teens at this point. She goes, I'm really glad you're not a cop anymore because you come home in such a good mood. Like when you were a cop, you would come home and it was like the world had just kicked you. And you come home now and you're smiling and you laugh and we do fun things all the time. And my heart just said, oh, you can't hang that up at the door when you come home. So I'm not saying law enforcement is not a bad thing. For me, it wasn't the right career to have a good, healthy relationship with my kids. So never went back. Thank you for your service. Hopefully you don't have the problems I did. Bang. Howdy. Thanks for sharing. Got to watch the replay. Awesome. Cool. If you do it on like 1.5, apparently I talk as fast as Pace Morby. Jack, regarding our outer space alien head vodka, the description on website says that it's 5 times distilled. Would you recommend it? I do. I'm mostly a vodka guy because I don't really like alcohol. I think I OD'd on alcohol when I was 12, and it was like a whiskey or a brandy, so I just can't do that. But I can actually breathe when I drink vodka. Bang. I need all this info related to Canadian rules, etc. Beautiful. So actually, I have an idea, but I don't know if it's the perfect idea. There's a YouTube channel called A Canadian Investing in the United States. So Maybe he doesn't. He might have all the reasons why he doesn't invest in Canada, so he would know those rules. But he knows all the rules of a Canadian investing in the United States. So that's the name of his YouTube channel. Too much vodka. A Canadian investing in the United States. Cool, Jack. And we're pretty much wrapping up for the night here. I appreciate everybody hanging out. This is awesome. We have over 100 likes. Thank you very much for each one of those. That's very awesome. T Stella, how do you feel about sheds converted to homes built to code used for ADUs? As long as it's built to code, it's not much different than a tiny home. And there's an attraction for it. Blake, howdy. Just got on this stream, been deep diving through your videos, wanted to follow up on insurance on rental question. Okay. You had mentioned don't bring up rental property insurance or landlord property insurance when reaching out to insurance companies for quotes. Well, it's not so much don't bring it up, it's don't fall for it. Rental insurance is something the tenant gets to cover their stuff. Landlord insurance is a made-up BS word that agents use to get you to pay more money. You need property insurance. Doesn't matter if you have tenants or not. You have property insurance. And I do $300,000 slip, fall, or injury coverage, and then full replacement value of the property. So the lender will require that you have enough insurance to cover the mortgage. I want to be made whole, not just have the lender made whole. So I do full replacement value of the building on my insurance policies. When you live there, it's going to cost you more because the insurance company is going to insure your stuff. When you move out, so I moved from a duplex into a fourplex, switching where I house hacked, the insurance on my duplex went from $900 a month to less than $500 a month because I no longer lived there and had to insure my stuff. It doesn't cost more because it's a landlord policy, because it's just homeowners insurance on the property where tenants live. But I hear a lot of people talk about, I need landlord insurance. And so the agent will go, oh yeah, landlord insurance, so homeowners insurance will be this much, but with landlord policy added on here, it's going to be this much. You can get a landlord policy to cover lost rents, which I've never done. That's literally what our reserves are for. So I guess that could technically be a landlord policy that you might want. I've never gotten that. I also do the highest deductible because I'm never going to do an insurance claim unless it's like a total burn down or somebody really got hurt. Cool. Thank you, Blake. And howdy, Blake. Nick, howdy. Dion, there's a property in my buy box. It's overpriced and has been on the market for 60 days. Seller doesn't have enough equity in it for sale. Seller financing only works if my offer is 20% under list. What to do? Have you made the offer at 20% under? So remember, we're looking for the motivated seller who has to sell. If they're overpriced, they're not going to sell. If they have to sell, they'll come down to the number that makes sense. And if that number makes sense with yours, go for it. If it doesn't, you just move on. 60 days on the market. They've probably gotten a few under asking price offers. There might be some other reasons why other people have backed out of that deal too. So I would maybe have your agent ask their agent, has there been an inspection? Have people backed out because of damages that they found? Or what matters to the seller? What do they need? What is holding them up from selling? And it might be they're underwater and they owe more than it's worth, and then you're just not going to buy it. So assuming their loan might be an option, that it's not owner financed. It's we talked about at the beginning of this video too, like a wraparound mortgage where you take their mortgage over. The lender has to be okay with it. You have to agree to the payments. So that's what I would do. I would reach out to this listing agent and find out what matters to the seller, and actually make the offer at 20% under. After 10 days, I'll make a 20% under offer if it's where the numbers make sense to me. So if they're at 60, I definitely would have made that offer already. Let me know how that goes. Should I be trying the standard big companies as well? I'm sorry, Blake, I missed that part of your thing. So I hit all of them. I hit from Allstate, State Farm, Geico, Farmers, a broker or two to find out who's got the best rates on insurance. And it's different from year to year. Yeah, so that's your broker, the person who runs quotes through a bunch of different companies. I check both. I've usually ended up with the broker, or now I'm with Geico using Stillwater Insurance. All day hauling. Howdy. Do we pay off all debt first, or what do you recommend as first step for second investment home? I have a video on my channel called Invest or Pay Off Debt First, literally answering that question. What I did is all debt that was 6% or higher, I focused half my savings to pay it off. The other half my savings went to the investing thing to start house hacking. So house hacking made a huge change. That's why I was trying to get there quickly. Debts 6% or lower, I would wait until the income snowball kicks in. Once you have that third or fourth rental property and the assets start producing more cash flow, use that to funnel and pay off all the bad debt then, and don't create more. So that's what I would do. I kind of divide it, pick an interest rate that makes sense to you. It might be 8%, it might be 4%, but everything above that you focus and pay off, because you're going to get a better return on that than because it's a guaranteed 6% or 7% return, whereas an investment should get a 10% or an 8% or whatever you're shooting for, right? But it's not guaranteed. Paying off debt that has a high interest rate like that is a guaranteed return. So I would do that. And then the lower ones, make the minimum payments. And whenever you start getting the income snowball, year 5 or 6, that all pays off that debt. The video, Invest or Pay Off Debt First, is longer and more nuanced and detailed. Cool. Awesome. I want to thank everybody for hanging out tonight. I appreciate it. Jeremy, good night. Blake, such as Allstate, yep, who's been doing our personal. Yes, but Allstate, you check with them, but they were the most expensive on mine when I looked at it. Blake, Nick, thanks for your time. Blake, your rates are crazy low compared to ours in Oklahoma, averaging over $1,000 a year. I would shop around for similar insurance, actually not even as high an umbrella. Yeah, shop around and compare every couple of years. Absolutely the year when you're getting your property, but then after that, every 2 or 3 years, I check around to make sure I've got the best rates. And I sometimes change for the next year. Okay, Chet, howdy. Hey, Dion, my wife and I are currently living in a home, 30-year fixed rate, 2.25% VA, and we are expecting our first child, but we are looking to buy a new home while renting out the first one. Realistically, how much of a down payment will we need? Possibly 0. You can have more than one VA loan. You have a certain entitlement, and if you haven't used all of it yet, you can use your VA loan again. You own a house, so if you use conventional to buy your next one, it's going to be a 5% down conventional loan. If you go FHA, which you can do even though you have VA loan, it's going to be 3.5% down. So realistically, 3.5 or 5% of what you're going to purchase. But I would check with lenders about your VA loan, because you can have more than one at a time. It's not like FHA where you have to refinance out of it. You can have one in a VA and use it again, especially if you go, we're having a kid and we need a bigger house. That's what it's designed for. So thank you all very much for coming. I appreciate it. This has been awesome. We are at the 4 hours and 2-minute mark. These were some awesome questions. I so much appreciate it. I'm going to be back next Tuesday with a live stream. Thursday, I'm probably doing a live stream, but it'll be on my phone where I can't answer questions. I want to do stream of consciousness, why interest rates went down in a time when the Fed is raising rates, has raised rates twice. And I'm going to do a live stream on the hidden cost of property management. Those will both come out on Thursday. So until my next video, you guys have been awesome. Thanks for coming to my Dion Talk. But I can't leave vodka in a glass. Maybe I should have.